All right, so hello everyone. Good morning, good afternoon, or good evening, depending on where in the world you're catching me from. Great to see all of you here today, and welcome to this webinar. Give me a couple of seconds while I share my screen. Okay, there we go. My screen is shared. Give me a second. All right, great. So sound check. If you can hear me and you can see my slides, do me a favor and type yes into the chat box, and you can mention where you're from as well. Wow, too many people to mention, all right? But thank you. I see someone from Dallas, Texas, from Colorado. I've got people from Namibia, which is South Africa. So many from Singapore, from New Jersey, Manila, Canada, New Zealand, Houston, Texas, Malaysia, Hong Kong, and too many to mention. Okay. All right, guys. Thank you so much for being here. So I believe that some of you are here today because you want to learn to create another source of income for yourself, trading the financial markets, whether from home or anywhere in the world. And some of you are here because you've got savings set aside and you want to grow your savings at a much better return so you can build your wealth a lot faster and you can achieve financial freedom, financial security in the near future, right? So today I'm going to share with you exactly what it takes and what you need to do to achieve consistent profits from your investments in a stress-free, low-risk way, more importantly. And even more importantly, in a way that's sustainable for the long run. So you create generational wealth. We're not interested to just make short-term profits because that may not be sustainable. But how do you create long-term generational wealth, right? And I'm also going to show you today the exact strategies that I use to create now an over $11 million stock portfolio and how you too can build a multi-million-dollar nest egg, even investing from an average income. It can be done, yeah? And more importantly, today we're going to focus on how to capitalize and how to profit on this technological revolution that's driven by AI, generational AI. And this is the greatest revolution since the internet 30 years ago. Yeah, this revolution is going to change all our lives, whether you like it or not, for better or for worse. And many of you would know that as we go through this revolution, some people are going to end up poorer, unfortunately. These are the people whose jobs are going to get replaced by automation, by AI. But there'll also be a lot of people whose lives are going to change for the better, who are going to be a lot more wealthy because they learn to leverage on these AI tools. At the same time, they learn how to invest in AI assets. So by being here today, I'd like to show you what are the skills you need and how do you look for opportunities to be that group of people who benefits immensely from this technological change. In the last revolution, we call that the internet revolution that started in the early 2000s, right? So that was led by Steve Jobs and Bill Gates. They created this software internet revolution. Well, they led it at least, right? And of course, Steve Jobs is gone. Bill Gates, the last surviving member, he said that AI is not just a novelty, right? AI is here to stay and it's the most revolutionary technology in decades. So it's something that we can't afford to miss out on. We cannot afford to miss out on this, right? So there's going to be a lot to learn today. Take lots of notes. If you have questions, wait for the Q&A session. I'll be having a Q&A at the end of the webinar. Also, when you stay to the end of the webinar, I'll be sending you the latest copy of my monthly investment newsletter. Also, at the end of the webinar, we'll be giving you a chance to join our courses and my private community where you get my live buy and sell alerts almost every day, right? At like 60% discount today only. So stick all the way to the end and get all these great gifts that we are giving out for this webinar, right? Okay, so if you guys are ready, let's get going. Now, for those of you who have been following me for some time, you know that on the 15th of January, early this year, I called the start of the bull market. Now, at that time, the bull market already started for 3 months because the bottom of the bear market was October 2022. So on the 15th of January, I said, we've got the signal, right? The 50 moving average is above the 150 moving average. That's a technical signal of a new uptrend bull market. Now, by that time, my account was already up about $469,000. And I think most of you were already making money because we started buying stocks at big discounts late last year, right? Right now, we are 9 months. Yeah, we are 9 months into this bull market. And I'm sure many of you would be seeing double-digit returns in your portfolio, right? Now, personally, for me, you can see one of my portfolios here. I'm up 38% year to date. And this other portfolio up 33.8% year to date. My total gains for the year is about $1.5 million US. Now, I know there are some of you here who have much higher returns than me, right? In fact, this morning, I was looking at my private community because we chat 7 days a week, 18 hours a day. We are chatting and sharing ideas with each other. And I'm just going to show you this. This morning, one of my students on our Discord chat group, right? He just posted here, right? Asyang Lim, right? Finally broke 100% year-to-date returns, 120% return this year, okay? So yeah, many of my students get much higher returns than me. They get, 50%, 100% returns than me, right? And I'm sure many of you get much higher returns as well. And one of the reasons is because I tend to be very, very conservative. So I make very, very safe investments and I don't really use leverage as well, all right? And at the same time, I've got a relatively bigger account. So when you've got a bigger account, you're more conservative, right? So my goal is not to make the highest returns every year. My goal is to make the most consistent, sustainable returns every year so that I'm building my generational wealth. So that's what I want you to do as well, okay? So a lot of people are now saying, Adam, the market has moved up so much, so fast in the last 9 months. Is the bull market coming to an end? Are we in a bubble that's going to burst very soon? And is it time to sell? How many of you have some of these questions in your mind right now? Like, is the bull market over? Am I too late? How many of you have these questions in your mind? All right. Yep. Angela, Patricia, Maggie, Jerry, Andy, Jamie. Sorry, I can't read all your names. It's going too fast. Okay, Michaels. Yeah. So understand that the average bull market lasts for 5 years. Okay. So right now we are only 9 months into this bull market. Just enough to make a baby. That's it. Okay. So average bull market, 5 years. But this is not an average cyclical bull market we are in. Nope. We are in what we call a secular bull market, which means a long-term bull market that's driven by innovation, by a technology revolution. Now, take a look at this chart over here, and you can see the long-term performance of the S&P 500, the US stock market, and it's made up of secular bear markets and secular bull markets. Now, the boxes in red are the secular bear markets. These are periods when the market goes into a cyclical bull, cyclical bear, but it ends up sideways for a long period of time. So, for example, over here, you can see this was a secular bear market over here. Can you see this over here? This was from 1937 to 1950. And then we had a secular bull market over here, then secular bear, then secular bull, and secular bear. And right now, we're in the middle of a secular bull market that started in 2013. Now, on average, a secular bull market, which is a long-term bull market driven by innovation, it lasts 20 years. It lasts 20 years. So right now, we are in the 10th year, okay? We're in the 10th year of this secular bull market, which means we are only halfway through. We've got at least another 10 more years to go. But I believe that it's going to last longer than 10 years because of this revolution, right? And not only that, but this secular bull market we're in is going to generate higher returns, much higher returns than all previous bull markets because of this super cycle of innovation that we're in right now. And I'm going to explain it a lot more in a short while. Also, another interesting thing to realize is that in previous secular bull markets, there are always two cyclical bear markets, right? So check this out. Can you see this secular bull market over here? From 1950 to 1966, right? So over here, you had a cyclical bear market here and another cyclical bear market. So two bear markets within this long-term bull market. Same thing here. We had a cyclical bear market here, cyclical bear market here, right? And in this current secular bull market, good news, we have hit the quota of our two bear markets. We had a bear market in 2020, if you recall, and another bear market last year in 2022. That's it. We are done for this secular bull market. So I think there's a high chance that for the next 10 years, we're gonna have a great run without any more bull markets. Sorry, without any more bear markets, right? Now, again, no one can predict the future. I'm not a fortune teller. It's just my guess. It's just a probability. But I think it's got a pretty good chance of happening based on historical patterns and historical precedents, right? So what's this sixth wave that we keep talking about, right? So let's look at it a bit closer. Now, every few decades, not every few years, every few decades, there comes about a wave of new innovation that totally changes our lives, that transforms economies, that transforms businesses, that creates returns in the stock market, right? So in the last 250 years, there have been 6 waves of innovation. The first wave was driven by water power, textiles, iron, okay? Now, this was, of course, before we were born. This was in the 18th century, okay? Then the second wave was driven by steam power, rail, trains, steel. Those were times when people who owned steel companies were the multi-millionaires of the time, like, you know, Andrew Carnegie and these kind of people, old people, right, who are dead, you know? And then we had the third wave that was driven by electricity, chemicals, and the internal combustion engine. This was when Henry Ford first created his Model T Ford, you know? And those of you who are older, the boomers, the baby boomers and the Gen X, people like me, we grew up in the fourth wave, where it was driven by petrochemicals, electronics, and aviation. So how many of you are from that era? How many of you are baby boomers and Gen X like me? People who are above 45 years old, right? So those were the times when, which companies were the most profitable? ExxonMobil, you know, Shell, Chevron, IBM, Nokia, and we had Ericsson, we had Sony. Remember that? These were the companies that were leading the way, okay? And those of you who are younger, I think most of you here who are younger, you would be most familiar with the fifth wave, which we just finished the fifth wave in 2020. So let's take a closer look at the fifth wave. So the fifth wave was between 1990 to 2020, so a 30-year period. And it was these 30 years that it was driven by the invention of software, right? That was actually created by Bill Gates at the time. And then, of course, Steve Jobs. So we started with MS-DOS, if you guys remember, right? Operating software and then application software like Excel, like Microsoft Word, you know? And then we had the invention of the internet. And I still remember that when I was in the army, back when I was 18 years old, the internet just got started at that time, very, very new. And when I was in the university, we first started getting onto the internet. It was a dial-up system. So it started with desktop internet, as you guys recall, okay? And then we went into mobile internet, and then social media came about. We had MySpace, we had Facebook, Instagram, and it all came about. And then we had cloud computing that gave way to video streaming, Netflix and YouTube, and now TikTok. Let me ask you this question. Did all these technological did this change your life? Did this change all our lives? Yes or no? Yes. Now, can you imagine your life today without software? We can't operate, we can't work, right, without software. But we were without software before this era. Can you imagine your life without internet today? I mean, for me, 5 hours without internet, I go crazy, right? Can you imagine your life without cloud computing? That means you've got no video streaming, you've got no TikTok, no YouTube, no none of those things. We can't imagine it, right? Because now it's part of our life. So the same thing in the sixth wave, when AI is the new revolution, soon we'll look back and say, how could we have lived without AI? It's going to completely change our lives. And because of this, companies were able to grow massively, make trillions, well, not trillions, billions of dollars, but now worth trillions of dollars, okay? So which were the companies that led the fifth wave? You've got Apple, the most valuable company in the world today. You have got Microsoft, you have got Netflix, Booking.com, Meta that owns Facebook, Instagram, WhatsApp, and you have got Alphabet that owns Google and YouTube. Now, here's the interesting thing. Is it only the tech companies that make a lot of money in the revolution? No. Like, if you think about it, Netflix is not a tech company. Netflix is a media company. And before that, they were selling videotapes, right? But they are a media company that use technology to transform their business. And Netflix made so much more money as a video streaming than selling videotapes. Same thing with Booking.com. Booking.com is not a tech company. It's a travel agent, but they use technology to now be the biggest online travel agent in the world. So my point is, you don't have to just invest in tech companies to make huge profits in a technological revolution. You just have to invest in any company, whether it's a travel agent, it's a media company, it's a pharmaceutical company, it's a bank, but the leverage on the technology. Does this make sense, everyone? Okay. And during the fifth wave, the S&P 500, the US stock market, gained 1,750%. which is about 10% annualized a year. Even with all the bear markets, it's 10% return a year. So in other words, as an investor, even if you don't know how to pick stocks, you have got no idea how to invest, but you just buy the ETF, the index, you're getting 10% a year without using any brains. An idiot could do that. An idiot should have gotten 10% a year for the last 30 years. Okay? Now, of course, you're going to learn how to pick stocks in this webinar. I'm going to share with you how we pick the highest quality companies. And when you do that, you're able to double or even triple the return of the index. And that is where we build really, really great generational wealth. What's also interesting is you can see that the S&P 500 gained 10% annualized for 30 years. But for the last 10 years, it gained 13%. So what's interesting is that not only is the market always going up, as I keep saying, but it's going up at a faster rate. Why? Because ultimately, what drives stock prices? Can you guys tell me? Type your answer. What drives stock prices at the end of the day? People say, oh, it's money supply, it's and all that. No. At the end of the day, it is earnings. It is corporate earnings at the end of the day. So if companies' earnings grow faster, their stock prices will go up higher. It's as simple as that. Everything else plays a part. By the end of the day, it's corporate earnings. And if you study corporate earnings, you know that corporate earnings are growing faster than ever before. Profit margins are expanding faster than before because of technology. And that's why the stock market keeps going up faster and faster, not because of just money supply or hype. Is driven by actual profits. Of course, you have to look at only the high quality companies, right? Now, let me ask you a question. How many of you made your fortune, or at least how many of you made great profits in the fifth wave? How have you made a lot of money in the fifth wave? You took advantage of this thing. Great, many of you, I see that, right? And how many of you, for whatever reason, you missed out making a lot of money in the fifth wave? Because you had no time, or because you were listening to the prophets of doom, like a lot of bears and chickens out there. Okay, all right. Now, so if you missed out, don't worry. Okay, don't look back, look forward. Okay, the good news is that the fifth wave is over. We are into now the sixth wave, and we are now the third year into the sixth wave. The sixth wave started in 2020, and like I said, it's going to last at least another 10 years. But I think it's going to last longer, and it's going to have the greatest impact on economic growth. So in other words, I believe the next 10 years, economic growth around the world is going to be higher than all previous decades. And I'm going to show you why in a short while. Corporate earnings are going to grow faster than they've ever grown. Stock returns are going to be higher than they've ever been. It's going to be the most revolutionary impact in our lives. And we cannot afford to miss out. We have to ride this freaking wave. Okay? So why do I say all these things? By the way, I didn't make all this shit up. Okay? All this is based on research by McKinsey and many other research companies, which we're going to talk about in a while. But the reason why the sixth wave is going to be so life-changing is because generative AI. How many of you have played with ChatGPT? I'm just curious. You kind of like played a bit of it, ChatGPT or Bard. You get a bit of a taste from it, right? That's generative AI. It's mind-blowing. But that's just the tip of the iceberg. It's just scratching the surface. So understand that generative AI, robotics, and automation will massively increase productivity. They will make us more productive, which means we can do more with less time, with less cost, and that will translate to much higher profits. Look at this interesting chart. In the 1990s, you needed 8 employees to generate 1 million in revenue. Now, this is, of course, not for small companies. This is for a Fortune 500, S&P 500 company, right? But over the years, to generate the same $1 million, it takes less and less people because of technology, right? Today, if you look at the S&P 500 companies, you need an average of 2 people to make $1 million. So what's going to happen in 10 years, right? So very soon, you only need 1 person to make $1 million. And then later, you need 1 person to make 5 million, 1 person to make 10 million, 1 person to make 100 million. Productivity. Now, those of you who are entrepreneurs, you can see this in your own business. Yeah. Like for myself, I've been running now my company for 21 years. And in the past, I used to have 120 employees. So I'm considered a very small business in the context of the world. Now in Singapore, I'm considered a medium company because Singapore is a small place, right? So I used to have 120 employees. Today, I've got less than 60 employees, but we generate more than 2.5 times the revenue. So I'm making more than double my revenue with less people. And my profits in the last few years went up 8-fold because of technology, right? Less people, more profits, more revenue. It's really amazing. And again, I'm only a small company. Imagine a multinational company, S&P 500 company. They can make billions and billions with less and less people over time. So they make more and more profits, right? The other reason why companies will make more and more money is because companies are growing faster than ever before because technology allows you to reach customers even faster. Now, think about this. Pretty amazing. In 1999, it took Netflix 3.5 years to reach 1 million subscribers. And then in 2006, it took Twitter 2 years to reach 1 million users. And then in 2004, it took Facebook 10 months to reach 1 million users. And then ChatGPT that came out last year only took 5 days to reach 1 million users. And last week, Meta launched their new Threads social media app, which I downloaded. Hope you guys are using it as well. It reached 1 million users in 1 hour and 100 million users in 5 days. That's mind-blowing. That's amazing stuff, right? Now, I can share with you from my own experience. Now, some of you may know that I've written many books. I've written 13 books, in case you didn't know, right? Go read my books, go find it on Amazon, right? Now, in the old days, I remember that when I wrote a book, it took about 2 years to reach 10,000 people to buy my book, okay? Today, I make a video, a good video, it can hit 50,000 views in 3 days. And some of my videos even hit 1 million views in half a year. So I can reach more people faster than ever before. In the old days, I used to travel around, right? I used to go to 3 cities a week, traveling on the airlines, giving physical presentations. And on average, when I talk for 2 hours or 3 hours, I reach 100 people, or at the very most 200 people. Today, because of technology, I'm speaking with you guys right now, and I'm reaching 5,000 people. I create a video on YouTube, I reach, again, 50,000 people. So again, that's just me. I'm just a small guy. Imagine companies, S&P 500 companies are able to reach, millions of people in seconds, more customers faster than ever before, and their margins, their profits skyrocket, okay? Amazing stuff. So McKinsey, which is one of the top consulting firms in the world, they recently did an entire research report, which I read. I hope you read it as well. You can go and download it from the internet. And they said that because of generative AI, it would potentially add 2.6 to 4.4 trillion annually to the global economy. So that's why I keep saying that in the next 10 years, economic growth around the world is going to be higher than in the past decades. We're going to see much higher economic growth, and that translates to higher profits for companies and much higher returns for the stock markets. Current generative AI and other technologies have the potential to automate work activities that absorb 60 to 70% of employees' time today. Half of today's work activities could be automated between 2030 and 2060. How many of you in your own life have used AI tools and are now saving a lot of time? I'm just curious. Okay. I experience it myself. I do a lot of research and I write a lot of articles. I write my newsletter. You know something, guys? What used to take me 1 hour, I now take 15 minutes. It's bloody amazing. I've got so much more time to do other stuff right now. In my company, my marketing department, they now use AI to write marketing scripts, to create videos, to create pictures. We used to hire designers. We used to hire artists. We don't need them anymore. What took my marketing team 1 hour now takes them 10 minutes. My God, that's just me, a small company. Imagine Fortune 500 companies. They can double, triple their revenue while cutting their costs, while cutting their manpower. It's going to transform their profits. And like I said, like it or not, it's going to change your life for better or for worse. If you don't know how to use this technology, you don't know how to invest in the technology, your job is going to get replaced very soon. But if you know how to use this technology, you know how to invest in it, my God, you're going to become really, really wealthy because of this, right? Now, every single industry is going to be impacted by generative AI and automation. But specifically, McKinsey has outlined 4 industries that's going to have the biggest impact, okay? 4 industries that's going to have the biggest impact. Number 1 will be retail. Retail and consumer packaged goods. So what kind of businesses are in retail? Apple's a retail company, right? Amazon's a retail company. Nike, Lululemon, Home Depot, Lowe's, that is the competitor of Home Depot. These are the retailers that are most leveraging on AI. Okay, so they estimate that an additional 400 to 660 billion of revenue will be added to these retail companies that are using AI, because AI could automate customer service, automate marketing and sales, as well as inventory and supply chain management. Interesting so far, everyone? Does it make sense? Pretty interesting stuff, right? Yeah, you bet. The next industry that's going to be very much impacted is banking. Banking, right? I mean, let me ask you, when was the last time you actually went down to your bank? Okay. I can't remember the last time I went down to my bank. Now everything's online, you know. When was the last time you wrote a check? I can't remember. I lost my checkbook, right? So now everything is all online. Banks are all virtual right now, and that increases their sales and profits. So McKinsey estimates an additional 200 to 340 billion will be added to the banking industry. So in the US, you've got JP Morgan, you've got Bank of America. In Singapore, you've got DBS, you've got UOB, you've got OCBC. Yeah. So banking, all right? Now, the third industry that's going to have the greatest transformation are healthcare and pharmaceuticals and medical products. Why? Here's something interesting. Do you know that about 20% of the revenue for pharmaceutical companies, drug companies, are used for R&D? 20%. Okay? And it takes an average 15 years, 10 to 15 years to make a drug. Now, with AI, they are estimating that this time that takes 15 years will now take only 1 year to make a drug. Think about it. And from 20% of R&D, it can drop to only 10% of R&D. They estimate that it's going to be 60 to 110 billion added to the pharmaceutical and medical industry. So what are some of the top pharma companies that are using AI? AstraZeneca, Bristol Myers Squibb, Johnson & Johnson. And by the way, healthcare companies are one of my favorite companies because, like it or not, the world is aging. We're getting more and more old people, me included, right? So healthcare, in fact, in my portfolio, a big part of my portfolio is invested into healthcare companies because that is one of the strongest growing sectors that's also recession-proof, right? Healthcare is a defensive, recession-proof industry. Now, finally, the fourth industry is obviously technology, right? Companies that are at the forefront of AI. So why is that really, really interesting? Because the global AI market is expected to grow at 38% compounded growth rate to 2030. 38% growth rate. I say that again, 38% growth rate. So if you're looking at where your money can multiply, you want to definitely be invested in the AI industry. But there are so many AI stocks. Which one do you invest in? There are hundreds of them, right? So we can divide all the AI stocks into three main groups, okay? We've got enablers, we've got enhancers, and we've got engagers. So what are enablers? Enablers are companies that supply the software and the hardware necessary to support the AI process. So basically, semiconductor chips. You need semiconductor chips and data centers in order to run the AI program. So these are the companies that create that support system to support the AI functioning. So first of all, you've got semiconductor equipment providers like ASML, Applied Materials, Lam Research, all right? You've got chip designers, NVIDIA, AMD, okay? You've got chip and memory manufacturing. We call them fabricators, right? You have got TSMC, the biggest in the world. You have got SMIC, you've got Texas Instruments, Qualcomm, Global Foundries. Then you got cloud service providers, which market leader is Amazon AWS, followed by followed by Microsoft Azure, followed by Google Cloud. You also have got Oracle, and then you got data warehouse companies like Snowflake. So that's the first group. Okay. The second group are the enhancers. So the enhancers are companies that utilize and manipulate big data to analyze the data, to use it to solve problems and create solutions. So data analytics companies like Palantir, C3 AI, automation and robotics companies like UiPath and SenseTime. This is a Hong Kong company, right? And then monitoring and control like Dynatrace and Datadog. And then you have got the ones we are most familiar with, which are the engagers. Engagers are companies that face the customer. That means you and me, we use them directly. So first you've got big tech, your Meta, your Amazon, your Alphabet. Then you've got autonomous driving, like Baidu, Tesla, BYD. You've got creative tools like Adobe and many more coming up. And you've got large language models, which are basically your ChatGPT, your Bard, right? So hundreds of these companies, right? Hundreds and hundreds of them. Now, question, will they all do well? Will they all make money? No, they won't, all right? Now, take it from someone who lived through the dot-com era. How many of you lived through the dot-com era? You started investing during the dot-com era. I did. So I remember it like it was yesterday. Now, if you recall, during the internet boom, or we call it dot-com era, this was late 1990s to early 2000, right? Every internet company went up like crazy. As long as there was a dot-com, it went up like crazy, okay? Good companies, bad companies, all went up, right? It was all driven by hype. But eventually what happened? The hype, once the hype dies, the bubble bursts, 95% of those companies no longer exist. 95% are gone, okay? Only 5% are left. Now, of the 5%, only 4% survive and doing okay, right? But only 1% are still doing really well today. Only 1%, like your Netflix, like your Amazon, like your Booking.com, like your Microsoft, only 1%. Now, the same thing will happen in this AI revolution, where 95% of AI companies are not going to survive. Okay, they're not going to survive. And that's why for us as investors, please do not blindly buy any stupid AI company that's I've got AI. No, right? So you got to make sure that as a savvy, intelligent investor, we want to not only make money, we want to outperform the market. We want to outperform the market because you see, if you don't want to outperform the market, just buy the ETF. If you just buy the ETF, you just get 10% a year, right? No brainer. But in this webinar, I'm going to teach you how to outperform the market. How do we double that or more, all right? So to do that, I only want to focus on investing in the top 1% of companies in the market. Only the top 1%. The highest quality companies with the strongest earnings, with the strongest economic moats. The ones that will not only survive, but thrive. So my approach is, again, buying the highest quality companies, but only buying them at significant discounts when they are undervalued. Okay. Now, some of you may say, but Adam, the price has gone up so much. Some of them are no longer cheap. So how do I miss out? Don't worry. Remember, in a bull market, prices will not go up every day, every week, every month. They will not go up in a straight line. You can bet that there'll be ups and downs along the way. There will be coming corrections. So during those corrections, when people are spreading bad news, when people are panicking, that's the time you want to be buying. All right. So that's what I do for my community. Like, for example, 2 days ago, United Health and Elevance Health which are both the biggest health insurers in the US, there was some bad news about the health insurance industry, right? And the price dropped a lot in the last few days, and people spreading bad news. And I was buying. My students were buying, right? And just yesterday, when they announced earnings, it's now up 8% in just a few days, right? So I'm going to teach you how to identify the great companies and how to buy them at discounts when people are panicking. So this is called value momentum investing. Now, I must tell you one thing. My approach may not make the highest returns. It may not give you the highest returns because, again, there are people out there who get 100% a day, 100% a week. Why? Because they take very high risk. They buy very speculative stocks. They use a lot of leverage. I don't do that shit. You know why? Because I'm a very conservative person. To me, the most important thing is not to get the highest return, is to get the most consistent return. How many of you are with me? How many of you are with me here? It's not to get the highest return in the short term, is to get the most consistent return in the long term that is sustainable, okay? So my number one rule for investing is like copying Warren Buffett, right? Because he's one of my early role models, right? My number one rule for investing is not to get the highest returns, no. Can you tell me what's my number one rule for investing? Can anyone guess? That's right. Thank you, Brandon, Safran, Vera. Yeah. My number one rule for investing is to never lose money. Is to never lose money. Is to sleep comfortably at night. Is to sleep well. So even in the short term, when the market goes down, bear market, I'm cool because I know I've got great companies that will rebound very fast eventually. Number one rule, never lose money. Okay. Then number two rule is to get the best returns of those companies that are the safest. That's my approach. Okay. So for example, if you look at the last 4 years, now let me ask you this. The last 4 years, was it an easy time in the stock market? The last 4 years. Was it an easy time? No. Think about it. Last 4 years, we had two bear markets in the last 4 years. Two bear markets, right? 2020, 2022. We had COVID-19 pandemic. We had a bank crisis. We had Ukraine war. We had super high inflation. We had a Fed that keep raising interest rates like crazy. We had a really tough 4 years. But my students and I managed to beat the market in the last 4 years. You know, personally, let me show you my 4-year track record, right? This is from 2019 January to July of this year, right? You can see in green, that's the S&P 500. And in blue, that's my portfolio, right? I'm up 128% in the last 4 years. So like I said, I may not have the highest returns, but I can sleep at night because in the worst bear markets, in the worst crisis, I come out even more profitable, beating the market. And I'm going to teach you how to do this as well in the Value Momentum course. And when you subscribe to the UIP, which is the Ultimate Investors Playbook, you will be able to watch me invest and trade live every day, where every time I buy something, I sell something, I do a screenshot of my portfolio. You can see my live buys, my live sells. And I also share my option trades as well. When I trade options, I do a screenshot. You see it live every single day, right? And you can see how I deal with market fluctuations, how I deal with my emotions, how I manage my portfolio. You learn like an apprentice watching me every day, right? And you can subscribe to UIP to get that really close apprenticeship, if you will, right? And that's how people cut short their learning curve, you know? Okay, so what are the keys to successful investing? How do you beat the market consistently, even in the worst of times? They are altogether 4 keys. So grab your pen, grab your paper, write this down. This is really important, the most important part of this webinar, okay? The 4 keys. And I like to use this acronym, WWHW. Write this down, WWHW. So what's the first W stand for? The first W stands for knowing what to buy. The first thing is you must know what to buy, right? So example, in the US market, there are over 5,000 stocks, even more in Hong Kong and China, okay, even more in India, right? So do we want to buy all the stocks? No, we only want to buy the highest quality stocks. Now, always remember, when you buy a stock, what are you buying? Are you buying a lottery ticket? No. So remember this, when you buy a stock, you're buying a piece of a business. You're becoming the part owner of a business. It's as simple as that. If the business does well, you will do very well. Very simple. Regardless of short-term news in the markets. So I keep telling my students, ignore the short-term news. Write this down. Ignore the short-term news. That creates volatility. Ignore that shit. Just focus on the actual business. If the actual business is making more and more money every year, if it has got little competition, you will do very well, okay? So, in other words, we only want to buy great businesses. We are not interested in buying good businesses. We are not interested to buy average businesses. We are not interested to buy lousy businesses. No, we only want to buy great businesses, the best of the best. We call it the best of breed. Now, you may say, how do I know it's a great business? How do I know it's great? Okay. So later I'm going to show you, I've got a 7-step criteria to select great businesses. Before I invest, it must pass my 7 steps. So I know it's a great business. Okay. Now, number 2, second key is you must know when to buy. Why? Because a great business can be a bad investment if you pay too high a price for the shares. If you buy the shares above its intrinsic value. Like, is NVIDIA a great business, everyone? Is NVIDIA a great business? Yes, it's a fantastic business. Is Apple a great business? It's a fantastic business. But right now, currently, it is overpriced. So if you buy it right now, it's very dangerous. Yes, it can still go high in the short term because of hype, but over time, it's going to be a bit risky, okay? Because you may get less returns if you buy at this price. So a great business is only a great investment if you can buy the shares when it is undervalued, when you buy for less than what it is worth. So for example, NVIDIA, the intrinsic value, if you do a calculation, it's about $210 a share. That is the actual value of the business based on the cash it is generating. So I bought NVIDIA last year at $150 because it was cheap. Now, I wouldn't buy it. In fact, I already sold half my shares. I still have another half. Have not sold it yet. Holding the other half, right? Same thing with Apple. Apple's intrinsic value is about $150. So I bought it last year at about $125 because it was cheap, right? But now Apple's about $180, too expensive. I wouldn't buy it right now, okay? So you must know when to buy. So we only buy when it is undervalued and at technical support levels. So this way you have to use technical analysis to look at the chart patterns to add at strong support levels. And I'll talk more about this in a short while, okay? Then some of you will say, how do I know what's the intrinsic value? Okay, so that's where you have to learn to calculate intrinsic value. And we use a lot of methods. In the value momentum investing course, you're going to learn there are many methods for valuation. And you use different methods for different types of companies. Like for example, for banks, you have to use the price to book ratio method. For REITs, you have to use dividend yield and price to NAV. And for most other companies, you use a discounted free cash flow method or a discounted net income method. So all this, I'll give you examples in a while, all right? And later, we'll look at some companies. We'll look at the different AI companies, and let's see which ones are worth investing in, shall we? Later we'll do a kind of like a live demo, yeah? But right now, I want to cover the concept. Okay, what's the third key? The third key is you must know exactly how many shares to buy. Okay, why? Listen very carefully. Listen very carefully. No matter how great you think a business is, never put all your money in one stock. Never put all your eggs in one basket, because no matter how great a business is, shit can happen. Shit can happen that you can't foresee. Like, for example, Alibaba, Tencent, China companies, they were great companies. But what happened? The government cracked down. COVID-19, bloody Alibaba, Tencent dropped 80%. Holy shit, right? Boeing is a great business. You know, Boeing, the aircraft manufacturer. But what happened in 2020? We had the COVID pandemic. Airplanes canceled their orders. Boeing had a plane crash. It dropped 80%. Holy shit. Okay? So imagine if you put all your money into Alibaba or all your money into Boeing, you shit your pants, okay? Now, no doubt, I believe that these companies will rebound. They will rebound. They will go back eventually. In fact, Boeing has really started rebounding. Alibaba, not yet, right? But if you put everything there, it's going to be very tough psychologically. That's why I tell my students that you must always diversify. You must always diversify into minimum 8 to 10 great companies. Minimum 8 to 10 great companies. So that even if one or two of them shit happens, it's okay. The rest of them will do very well and buffer the short-term drop in the ones they got hit. Like in 2020, I can tell you that I own Boeing as well. I bought Boeing in 2016, right? And my Boeing stock dropped 80% in 2020. Holy shit, right? But I didn't care because I had other companies. And in the end, in 2020, my portfolio went up more than 40%. Same thing. I also own Alibaba. I own Tencent. Bastard dropped 80%. I don't care because I got other good shit, right? My portfolio still went up every year, right? Even during the China crash. So it's all about portfolio diversification and portfolio allocation, which I'm going to talk more about later on. Never put everything in one stock. Yeah. Okay. The next key is what? You have to know exactly when to sell. You must know when to sell. So when you sell, you can sell if the stock becomes way overvalued. It's like 100%, 200% overpriced, nothing wrong selling it. Even if it goes high in the short term, doesn't matter, sell it and reinvest into another great business that is still cheap. Or if the fundamentals of the business permanently deteriorate. Like I used to own Meituan last time. You heard of Meituan, a China company? I bought it at 70. I sold at 400 because it was double overpriced. Then from 400, it dropped back to below, I think below 200. I wouldn't buy it because the fundamentals deteriorated permanently because of regulatory changes. In my opinion, Intel was a great business, but the fundamentals have deteriorated permanently. Same thing with PayPal. All right. Same thing with Sony. You know, so when people say, Adam, why don't you buy PayPal? It looks so cheap. Why don't you buy Sony? Why don't you buy IBM? It looks cheap. I wouldn't buy because if it's no longer a great business, I don't care how cheap it is. I don't care how cheap it is if it's not a great business. So write this down. Write this down. One of the biggest mistakes people make is they buy something just because it is cheap. Remember, cheap crap is still crap. That's why the most important thing is that it must be a great business. If it's not great, don't count how cheap it is. Okay? Does this make sense, everyone? Is this useful stuff? Okay? Now, are there people who lose money in investing? Are there people who lose money in investing? Yes, there are. Why? Why do people lose money in investing? There are only 4 reasons. If you lose money in investing, there's only 4 reasons. The first reason is you don't know what to buy. And you probably bought lousy companies that are not profitable. then you buy it because it got hyped up by the media. That's why a lot of people, they bought what? Peloton and Roku and what's that? I don't know. A lot of unprofitable companies, right? Because it was hyped up, okay? Second reason people lose money is they say, yes, I buy a great company, I buy a great company, but they bought it when it was way overpriced. Right? They overpaid for it. And then after they buy it, it collapses, they panic and they sell it and they lose money, right? And third reason is they don't know how to diversify. So again, they put all their eggs into one basket, right? Excuse me. They put all their eggs into one basket. And then when it drops like an Alibaba or like a Boeing, they panic, they sell, and they can't hold on to it, and they destroy their portfolio. Or the fourth reason is they don't know when to sell. They say, I know what to buy, I know when to buy, I don't know when to sell. Then all the profits disappeared, okay? That's why I keep saying that if you want to be a successful investor, you have to master the 4 keys, not just what to buy, you know? And that's why I don't like to give people stock tips where people say, hey, what do I buy? I dare not tell people what to buy. Why? Because I may tell you what to buy, but you don't know when to buy, right? You may buy the wrong time, or you don't know when to sell, or you don't know how to build a portfolio with other great companies. And if that particular one shit happens, then you get destroyed, you know? That's why in my private community, in my investing group, we don't just know what to buy. We know exactly when to buy, when to sell, and exactly how many shares to buy. That's how we beat the market, okay? So let me spend a bit more time on the first one, because let's go into detail. Yeah, what to buy. Now, like I said, I have got a 7-step criteria for investing. Before I invest in any business, it must pass my 7 steps. Now, make a quick guess. What percentage of stocks in the market are safe enough and great enough to invest in? Yep, I gave you the answer earlier on, if you were listening, right? Yeah, that's right. Some of you didn't listen. Some of you are giving the wrong answer. Yeah, what's the answer? Yep, the answer is 1%. Remember this, only 1% of the stocks in the market are great. These are the only ones you want to invest in. Now, the 99%, you could trade it for the short term, one night stand. In fact, I'll be talking about trading tomorrow. So tomorrow is my trading webinar where I'll teach you how to have a one night stand for these speculative 99%. We call them the slut stocks, all right? But today we're going to focus on the 1%. These are the 1% high quality marriage material, the ones we want to marry, right? For the long run, they're going to build our generational wealth, okay? Yeah, I call them the slut stocks, okay, right? So what are the criteria? Let's run through them. Criteria number 1. Criteria number 1, I only invest in businesses that have a history of consistently increasing sales revenue, net income, and free cash flow for at least the last 5 years. Write this down. For at least the last 5 years. That means in the last 5 years, I want to make sure that the business, year after year, the revenue is growing. The sales are growing, the profit is growing, and is generating increasing free cash flow. Why? Why? Because if a business can increase revenue, profits, and cash flow for the last 5 years, that means the business is predictable. The business is consistent. And the business is resilient. Okay? Now, can all businesses do this? Can all companies do this? No. In fact, less than 5% of stocks in the market can meet the first criteria. So if you just apply my first criteria, it would eliminate 95% of all the stocks. All right. So let me give you a few examples. How many of you are Singaporeans, by the way? Type if you're Singaporean. Okay. I know there should be quite a number of Singaporeans today. Yeah. Okay. Brandon, Sarah, Hui Min, Owen, Kenny, Lynette, Mark, Joanne, Charles, too many to mention. Okay. Hello, Singaporeans, fellow Singaporeans. Yeah. Thank you for coming home. Very happy to see you all. Okay. Now, a lot of people ask me, as a Singaporean, should I invest in Singapore Airlines, SIA, national carrier, right? Because nowadays borders are all reopening, everyone is traveling, and Singapore Airlines, the profits are doing really, really well. So let me just say that, I love Singapore Airlines. I love SIA as a customer. I love Singapore Airlines as a proud Singaporean. But will I ever buy the shares of the stock? No. I'll never buy shares of SIA. Why? Because to me, all airline businesses are lousy businesses, no matter what airline. Okay? Why? Because they all fail the first criteria. Their revenue is not consistent, their profits are not consistent, and their free cash flow is not increasing. Okay, so let me show you. So if you look at Singapore Airlines over here, let's look at the fundamentals. Now look at the revenue growth over time, right? Now look at the revenue, it's growing here, and then go down here, and go up here, and go down here. And of course, what happened? COVID, boom, and go up here. So it is not increasing consistently. The revenue is very up and down. We call it very cyclical. So it's best to avoid cyclical kind of businesses. Okay. Then look at the net income, which is in green. You can see out of so much revenue, the profit is so little. Why? Because airline businesses have very low profit margins. Because it's a very price competitive business. They have to compete with many other airlines. So they can't charge very much, right? And not only that, but there's a lot of costs like wage costs, fuel costs, maintenance costs. They have to keep maintaining their planes, buying new planes, and that sucks up their capital. Understand? And you can see the revenue growing, but the profit drop here. Revenue grow, profit never grow, right? Profit low, profit went up a bit, profit went down, profit went up, profit went down, lost money, lost a lot of money, lost money, make money for 1 year. Right? It's not consistent. Make money, lose money, make money, lose money. It's not consistent. All right? And look at their free cash flow. Now, very important, as an investor, the most important thing in the financial statements is revenue and free cash flow. Write this down. Free cash flow is the most important. What is free cash flow? It's the cash the business can earn minus the capital expenditure. What is left to give dividends or to buy back shares? That's the free cash flow. Now look at the free cash flow of SIA. The free cash flow is negative, 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 slightly positive, negative, 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 positive. My God, look at that. Out of 10 years, 9 years, the free cash flow is negative. That means the company is losing more cash every year. Now, if the free cash flow is negative, the cash keep getting less and less. What happened? It has to keep issuing more debt to keep raising money or issue new shares to raise capital that dilute shareholders. All right? So you can see that it's a lousy business. Now, this is not the fault of the management. SIA has fantastic management, but it's because of the industry. The entire airline industry is just like that. It's not their fault. You understand? And so when you look at this kind of business, in the long run, the stock price can't really go up very much, although it can go up in the short term sometimes. So this kind of stock, good for trading, slut stock, but not very good for investing. All right. Excuse my language, just being a bit playful today. All right. Okay. Now, so for example, if you look at SIA, you can see in the short term, it looks very good, right? In the last 1 year, with the borders reopening, it's like, whoa, fantastic, it's going up, right? So some people think, buy the dip, buy here, right? I wouldn't dare. I wouldn't dare, because I don't know if it's sustainable, right? Because if you look at the history, right? If you look at the long term, look at the last 5 years, what happened? If you bought here 5 years ago, after 5 years, back to square one, right? And even if you bought 10 years ago, let's look at 10 years. If you bought 10 years ago, here, right? After 10 years, back to square one, all right? So I tend to avoid this kind of business, not consistent. And then some people ask me, Adam, would you invest in Grab? Any of you here invest in Grab? Because Grab is very popular in Asia. It's like an Uber, right? We grab food, grab transport. It's like, and I like to use Grab as well, but I won't buy the stock. Why? Because it fails the first criteria. Let's look at Grab. Yeah, revenue is growing, right? Revenue growing, but look at the net profit, right? Losing money, losing money, losing money, free cash flow negative, 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 not making money. Remember that a business is a money-making machine. The more money it makes, the more it is worth. If it doesn't make money, what are you paying for? What are you paying for? You're paying for the hope that one day you'll make money, right? So some people say, but Adam, some of these companies can make a lot of money one day, so it's okay to buy them now. Yes, there are some companies who don't make money now, and one day they could make a lot of money. Yes, I agree, but they are very rare. For every one business that makes it, 99 will never make it. So if you buy a business that's not making money, it's like kissing a frog and you hope the frog will turn into a prince. Yes, some frog will turn into a prince, but not many frogs, right? Most frogs will remain frogs. And if you keep kissing frogs every day, you get dirty mouth, and frog can be poisonous, can die. So for me, I don't like to waste time kissing frogs. I just like to go straight for the prince, or in my case, the princess. Make sense, everyone? And again, if you look at Grab, what happened? People buy because of the hype. Oh, Grab, oh, and then, but don't make money, what? Then how? Then the stock price, now, will it ever go back? I don't know. Depends. Will it ever make money? I don't know. We can't predict. So we don't want to buy companies where we don't know the future. We want companies that have a solid, proven track record of making money in every market condition. So what kind of companies do I buy? Right? What kind of companies do I buy? I buy companies like MasterCard, right? Visa. Why? Check it out. Let's look at Visa, MasterCard. By the way, Visa, MasterCard, they are not credit card companies. They are not credit card companies. American Express is a credit card company. MasterCard, Visa are not credit card companies. They are payment technology companies, right? So if you don't understand that, go read about it, okay? Very different, very different. So if you look at MasterCard, look at the track record of the revenue. Is it growing consistently? Yes or no? Hallelujah. Is it growing consistently year after year after year? Okay. Look at the free cash flow in blue. Is the free cash flow increasing consistently? Is the net income increasing consistently? Yes. These are companies that I know are very predictable. Okay, another one of my favorites. I just bought more yesterday. Not yesterday. I bought more the day before. Yeah, United Health. This is the largest health insurer in the US. Okay, why? Look at the track record. Look at that. Look at the revenue. Whoa, baby. Recession-proof, pandemic-proof, very consistent, very predictable. Look at the free cash flow. Look at the free cash flow increasing every single year. These are the companies that are no-brainer, right? And once in a while, the market lets you buy them cheap. Like now, like United Health last few days was very cheap. That's why I bought more because very cheap. Okay, let me show you. So if you look at what's the first one again? MasterCard. Yeah, look at MasterCard. Look at MasterCard. Look at MasterCard over the long run. So it's not like SIA or Grab, but look at MasterCard. Consistently increasing, right? There was a bit of a consolidation last year. Now it's continuing higher. Okay. Look at United Health. Look at that. These are what we are interested in. These are the kind of stocks that we're interested in owning. Right? And again, does it go up in a straight line? Does it go up every day, every week, every month? No, it moves in wave patterns, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. It's like breathing pattern. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. Same thing here. Look at it. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Now it's on a wave down. So you want to buy near here. You want to buy here before it waves up, right? So that's why I've been accumulating a lot over here. Okay. Does this make sense, guys? Is this useful so far? Okay, so that's just the first criteria. Remember, there's 7 criteria that I have to pass before I buy it. Second criteria is the most important criteria of all, the most important of all, which is this. I only invest in businesses that have a sustainable, the keyword is sustainable, competitive advantage that protects it from competitors, taking away their market share and customers, right? So this is called an economic moat. Warren Buffett calls this an economic moat. Now, what's a moat? You know, in the old days, kings live in castles. That's a castle, right? And how do they protect the castle? By building a moat around the castle. What's a moat? A moat is a water barrier where they put crocodiles and all that, right? So the enemy cannot attack the castle because of the moat. Same thing in a business. When you invest in a business, you have to check, does it have a wide moat with a lot of crocodiles, or a narrow moat, only one crocodile, or no moat? Okay? We want to buy companies with a moat, either a wide moat or a narrow moat. Okay? Why? Because, listen carefully, when a company has a moat, when it has got a sustainable competitive advantage, it is protected from competition. So it has pricing power. It has pricing power. What does pricing power mean? Pricing power means it's able to raise prices easily without losing customers, without affecting market share. Like, for example, so in other words, we want to invest in businesses that have little or no competition. Write this down. We want to invest in businesses that have little or no competition, and competitors are not easily able to disrupt their business. Okay, so what gives a company this moat? What gives a moat to the company? A few things. Number one is a very strong brand. It's a very strong brand that creates loyalty and even a mental monopoly. So for example, one of my favorite companies from Europe is LVMH, Louis Vuitton. Okay, so LVMH, can they raise price every year? Yes or no? Yes, those bastards, they do. And the more they raise, the more my wife buy. Damn it. Okay. Now, when LVMH raise price, will people buy less? No, they buy more because it's more prestigious, right? Okay. Ferrari, another great business from Europe. Ferrari, when they raise price, will people buy less and buy Toyota instead? No, they raise price, people still buy, because people who can afford Ferrari will still buy Ferrari no matter what the price. We call that the brand loyalty. Same thing with Apple. Are Apple's products cheap? No, they're plenty expensive. Every time I buy an Apple product, I will complain and I will bitch and complain. Damn it, the bastards, but I'll still buy it. What? You want to sell me this cable for 50 bucks? Are you mad? Damn it, I still buy it. Why? Because it's Apple. All right. So you want to buy businesses where no matter how much the price, people will still buy, because it's the brand equity, all right? And also a brand monopoly in certain cases. Like, now what's a brand monopoly? Brand monopoly is when people mention the product, it's a top of mind recall. Let's play a game. Let's play a game. If I mention a product, you tell me the brand you think about, okay? So when I talk about search, every day we have to search for information. What do you think about? What brand you think about? Google, right? Google has a 90% market share. In fact, what do we say? Hey, go Google this, go Google that. It's become part of our vocabulary. It's a top of mind recall. And that's why if you look at Alphabet, which by the way is still cheap right now, still undervalued, look at the chart. In the long run, it always goes up because it's a brand monopoly. If I mention office software, whether you work from home or you work in the office, you have to use software, right? Microsoft, that's why. That's right, it's a brand monopoly. Microsoft has no competition. Look at that. Hallelujah. Hallelujah. Okay. Whichever country you go to Malaysia, you go to Singapore, you go to Egypt, you go to the US, you're hungry at night, you're hungry in the morning, everything is closed, but this fast food restaurant is around the corner. McDonald's, my favorite restaurant. I go there at least 3 times a week. I love McDonald's. Now, some Americans will say, really? McDonald's tastes good? Let me tell you something. Singapore McDonald's, very different from American McDonald's, right? Singapore McDonald's is really delicious. It's really beautiful. When I went to the US to eat McDonald's, I was like, ah. Right? So very different because of the garlic chili sauce. Okay, so anyway, McDonald's, look at McDonald's, one of my best investments. One of my best investments. Look at that. Look at that. Look at that, baby. These are no-brainers. You want to buy brand monopolies. Brand monopolies, okay? Now, besides brand monopoly, what else gives a company a moat? What else gives a company a moat? Okay? Is what we call high switching cost. High switching cost. I like to buy companies where the customer has high switching cost. What does that mean? That means that once the customer buys the product or the brand, it becomes very difficult or very expensive to switch to another brand. So they tend to be stuck with your brand for many, many years. Okay. So what are examples of high switching cost? Apple, Microsoft, Adobe. These are high switching costs. Like, for example, my daughter is now studying for her diploma. She's going to be doing her degree soon. And she's studying communication, journalism, and arts. And in the school, they give them Adobe software to do designing. So she'll spend 6 years using Adobe software, learning Adobe, right? After she graduates, do you think she will use a different software? Of course not, because she spent 6 years learning Adobe. So for the rest of her life, she'll be using Adobe software, paying licensing fees. And 90% of creative professionals around the world use Adobe software. So it creates a high switching cost. What are other companies with high switching costs? Salesforce, ServiceNow, Viva, Tyler Technologies. Most of these software companies have high switching costs because once a company uses their software, they spend millions to train their staff to use it, to install it, so they will not easily switch to another vendor because it's too costly to switch. You understand? So it locks in the customer for many, many years. AWS, Amazon Web Services. By the way, do you know that Netflix runs their business on AWS? And Netflix, if you read their financial report, they said that if we were to ever change to another cloud provider, it will take 3 years for the migration. 3 years to migrate Netflix out of AWS into another platform. So do you think they will likely do it? No. Imagine 3 years of disruption. So because of that, AWS, they have locked in many of these customers. They got them by the balls. Sorry. Okay. Sorry, children. Okay. So we want these companies, all right, that lock in the customer, right? What else? Now, again, I can't cover everything. It's going to take too long, right? But again, in the Wealth Academy and the Value Momentum Investing course, I'll teach you how to find companies that have all these qualities, that have a network effect, that the more people that use it, the more people want to use it because everyone is using it. So Apple, network effect. Adobe, network effect. Meta, Facebook, Instagram, WhatsApp, network effect. Amazon, network effect. You have to be there because everyone is there, right? High barriers to entry. Economies of scale. We want to buy businesses that have these qualities that create the moat with all the crocodiles, so competitors cannot come and take away customers. Does this make sense, everyone? Now, there's a lot more criteria. Let me just share a few more right now. Next one is growth potential. We want to invest in businesses that are in secular growth industries, that have huge growth potential. Now, I'm from Singapore. Let me ask you, do you think would you want to invest in children's education in Singapore or Japan? Yes or no? No. By the way, I've got a children's education business, right? And the only reason I'm running it is for a social enterprise to help people. But if it's for making money, then I wouldn't be there, right? Why? Because Singapore's birth rate is declining. Japan's birth rate is declining. Less and less children every year. So the business growth is declining. Okay. But would you want to invest in old age homes in Singapore? Would you want to invest in healthcare services? Yes, because there are more and more old people. People are growing older, aging population that has huge secular growth potential. Understand? So we only want to buy businesses in growth industries, not sunset industries. Conservative debt, right? I want to invest in companies ideally with conservative debt and a lot of cash so that in a recession, not only can they survive, but with cash, they can buy up their competitors. Has any of you invested in a business that went bust? I'm just curious. Any of you here? If you're from Singapore, it's quite common. Many Singapore businesses went bust, like HiFlux and Nobel Group, and some of them dropped a lot. They didn't go bust, but dropped a lot, like NOL and all that. And if you look at a lot of these companies, what do they have in common? Companies that go bust. What do they have in common? They are highly leveraged. They have a lot of debt, right? So to sleep well at night, focus on companies that have got very low debt, a lot of cash, right? And again, there's a lot more stuff. Like we look at things like return on invested capital, ROIs, and stuff like that, right? So let me give you another example over here, okay? So you see, if you only invest in the top 1% of companies that have little or no competitors, who make money, who make more money every single year, okay, who have got very little debt, then you're confident that these businesses will what? These businesses will increase in what? Increase in value over time. So this green line that you see, this is called the intrinsic value of the business. Remember, a business is a money-making machine. The more money it makes every year, the more it is worth. So the valuation keeps going up. Got it? So when you buy this kind of business, you are confident that if you buy the share price today, the share price will be a lot higher over time. But will the share price go up in a straight line? Once again, will the share price go up every day, every week, every month? No. And that's good, right? So understand that in the short term, write this down, in the short term, the stock price is not driven by the fundamentals of the business. In the short term, the stock price is driven by manipulation of market makers, which Alson will teach you how to decode the market maker manipulation, right? They are driven by news. They are driven by emotions, okay? So there are times when if there's hype and manipulation, the price can, whoa, can go way above the value of the business. It becomes overvalued, right? And then eventually the news will change, and then there's bad news, there's panic, or there's oversupply of semiconductors, or there's a war coming, or there's a crisis, and then, oh my God, we're gonna die. And the price can go way below the intrinsic value, right? And the cycle repeats. News cycle repeats, right? Then you got good news again, and bad news, good news, bad news, good news, right? And that's what happens. So we call this volatility. Now, as investors of great companies that know the great companies, do we like volatility? For someone who knows how to find great companies, do we like volatility? Yes or no? Yes, we love volatility. We love it. Because volatility creates the temporary mispricing of the business. It creates the temporary mispricing of the business. That means a stock that is worth, let's say, $200, or let's say, $200, could temporarily be selling at half price because of short-term manipulation or panic. Like Meta, that owns Facebook and WhatsApp. If you guys have been following me, I already told you the intrinsic value of Meta is about $300 to $350 a share. That's the intrinsic value. And last year, it was selling at $80, more than half price, because of all the bad news, all the manipulation. So if you knew the valuation, you would have bought at more than half price. That's why many of my students, we bought, because we know it's manipulated, it's stupid cheap, right? And again, a stock worth $200 could be selling at $500, like Nvidia. Nvidia is worth about $200. If you do the valuation, it's selling at $500. Could it go higher? Of course, it's hype. Will it last? No. Okay. So this is when we say it is what? Overvalued, right? It's overvalued, and this is undervalued. So as an investor of a great business, where you want to buy? Where's the safest point to buy? Here, let's call it point A, overvalued, or here, when it's undervalued? You tell me. Where you want to buy, A or B? All of you say B. All of you say B now, right? Danny, Brian, May, Mai, Clement, Zapata, Terence, Tusha, Ricardo, Robert, Mohammed, Safra, Mr. Boo, Simon. You all say B. But is that what you do in real life? Okay, I hope so. Because what you realize is that most people out there who are not trained in investing, they never buy at B. They always buy at A. In fact, most people, they tend to buy what? They tend to buy here. They tend to buy here when it's overvalued. All right? Why do they do that? Because most people buy and sell based on emotions. So what happens when they see the price going up, going up, going up, going up? Everyone make money, everyone get excited, they get excited. And by the time they buy, the price already went up. By the time they buy, it's already overpriced. And that's why after they buy, it may go up a bit more, but shortly after, it drops. Right? And after it drops, people panic and they sell. And when people panic, they panic and they sell. So they end up buy high, sell low, buy high, sell low, buy high, sell low. How many of you have done this before? How many of you, every time you buy a stock, it drops? After you sell it, it goes up again. Okay? So if you experience this, it's not because you are unlucky. It's got nothing to do with luck. It's got nothing to do with your 八字. It's not because the market gods hate you. It's because you're buying and selling based on emotions. And you're buying and selling based on reading the news. You see, what happens is that after a stock goes up, the media will give you the good news. Oh, it went up because of all these good reasons. And you thought, wow, all these good reasons. Company doing well, company making money, company is great. Buy. You're always buying the top. And after the price drop, the media will tell you all the bad news. Oh, because people are not using Facebook anymore, and then Meta's in trouble, and then too much semiconductors, right? And then you read all the bad news, oh my God, and then you sell. And that's why you always buy high, sell low, right? So if you want to make money consistently, you want to beat the market, you want to get double-digit returns, like me, okay, like my students, you have to train yourself to think opposite of everyone else. You have to buy when a great business, now again, only buy great companies when it's undervalued. Now, when is it undervalued? When it's good news or bad news? You tell me. When is a great company undervalued? When there's good news or bad news? When there's bad freaking news. That's right. Like, let me give you a good tip right now. The health insurance companies, United Health and Elevance Health, in my opinion, they are great companies. And right now, they are undervalued. Okay, because recently there was a lot of bad news. And that's why I was buying. But it really jumped up a lot on Friday, right? So of course, it's better to buy before Friday. But now it jumped on Friday. It's still cheap. It's still cheap, but not as cheap, right? Let me give you another tip. You guys want another tip? Another great company is Pool Corporation, P-O-O-L. Pool Corporation is the largest supplier and manufacturer of swimming pools in America. And it's a great business. And recently the price dropped a lot. And I also bought, right? But I bought a lot lower, right? Because of bad news. So you got to buy only good companies on bad news. Don't buy bad companies on bad news, because you buy bad companies on bad news, it never comes back. But you buy good companies on bad news, it always comes back. You follow what I'm saying? Right? So that's when there's bad news. And that's when there's always panic. There's always fear. Oops. What happened now? There's always panic and there's always fear, right? Okay, so do you guys understand now the concept I'm talking about? Okay, so now let's take what we've learned and let's go back and apply it to some of these AI companies that we looked at earlier on, okay? Now, so are they all worth buying? No. Now, again, we all have different opinions, right? And some of them, I would only invest in some of them. Some of them, I would not invest, but I would do short-term trading, but not investing. So there's a difference. So for today's session, I'm going to just focus on investing. Again, tomorrow, I'll talk about swing trading, which is shorter-term trading with stop losses, so that we can be more lenient. Okay, but for investing, we only invest in companies that, to me, is like 100% sure to make money. Okay, that I don't need a stop loss, I can buy, close my eyes, I know it's going to build my wealth. Okay, so among all these companies, which ones are great? All right, now again, which is one of the most important criteria? Which is one of the most important criteria, which I talked about earlier on? It must have a strong economic moat. Remember that? It must have a strong economic moat. So I want to invest in companies with wide moat. Wide moat means no competition and cannot be disrupted. That's called wide moat, right? Narrow moat means there are a few big players. And it cannot be disrupted easily as well. All right. But of course, wide is stronger. Wide, narrow, but we avoid no moat companies. No moat companies are companies where anyone can take away their customer, anyone can disrupt them, because there's a lot of competition. So certain industries have no moat. Like, for example, most manufacturing companies have no moat. Shipping companies have no moat. A lot of commodity companies have no moat because it's very price competitive. Okay. So out of all this, let me just show you a few examples. All right. So let's look at Alphabet. Now you may say, Adam, why Alphabet? Because I think out of many of them, Alphabet is still cheap. Is one of the ones that are still cheap right now, still undervalued. Okay. So let's look at Alphabet. Does Alphabet meet our criteria? Meet all the 7 steps? Now, let me just show you some of the steps. Let's look at Alphabet. Okay. So Alphabet owns Google, YouTube, and as well as their cloud, Google Cloud, right? And most recently Bard, which is their hyped up version of, not hyped up, souped up version of ChatGPT. Yeah. Okay. So if you look at Alphabet, do they have a history of consistent growing revenue? Is their revenue growing consistently? Yes or no? Yes. Is their net profit also growing quite consistently? Yes, right? Is their free cash flow in blue growing consistently? Yes. So it's very consistent, it's very predictable, right? Now, do they have a strong competitive advantage? Do they have a wide moat? Yep, they have a brand monopoly. They have a network effect, right? They have huge economies of scale. Okay. So yeah, it's got a strong moat. Yeah. Now, other things I like to look at is you can look at things like their profitability margins. Like their return on equity is 22%. Very high. Usually I want to make sure the ROE is at least more than 12%. I also look at ROIC, return on invested capital, very important. We want to make sure the ROIC is above 12% as well. And you can see it's 27%. So it's really, really very, very strong. Look at the gross profit margins. Gross margins are pretty consistent, 55%. Operating margins, consistent and growing 25%. Net profit margins, 20%. So these are very, very high margins. Okay. How about debt? Do they have high debt? Okay. You see their debt to EBITDA is 0.34, right? Very low. Usually I want it to be less than 3. Okay, that's way less than 3. Interest coverage ratio, 200 times. My God, that's insane. Usually, I'm just happy with 5 times. It's 200 times. Okay, so very strong business. So it definitely is a great business, right? But what's the intrinsic value? Is it expensive or cheap? Again, in the value momentum investing course, you're going to learn how to calculate the intrinsic value of any kind of business. And again, there are different methods, right? But for Alphabet, the best method to use is the discounted free cash flow method. So we use this intrinsic value calculator. Yeah. So once you enroll in the course, you can download this calculator. In the course, you'll be learning step by step how to put in all these numbers. It takes less than 5 minutes. You can get all these numbers from any website, like Yahoo Finance. It's all free. Okay. So Alphabet, what is the free cash flow now? How much free cash flow is it generating? 61.9 billion. There we are. All right. Next, how much debt do they have? They've got 12.8 billion in debt. Okay. How much cash do they have in their bank or in short-term investments? They've got 113 billion in cash. Okay. What is their growth projection? All right. Their current growth projection is 17% growth for the next 5 years. So to be conservative, I halve it for the next 5 years at 8.8%. And then I use a terminal growth rate of 4%. Okay. Number of shares outstanding, 12.7 billion shares, using a 6.2% discount rate based on its beta, which is relatively low. That gives me an intrinsic value of $167. So once I do this, I know, okay, great business. What's it worth? It's worth $167. And what's the share price right now? What's the share price right now? Let's look at the long-term chart. The share price right now is 125. Right? It's $125. So let's put it in. Okay. So is it still a pretty good deal? Is it still reasonably priced? Yeah. At 125, it's still a 25% discount. It's still cheap. Okay. That's why I say in this market, there are still great companies that are still cheap. There are still companies like that. Okay. Now, next thing, I don't just look at the fundamentals and the intrinsic value. I also look at the technical analysis. I look at the chart patterns to determine my entry levels. So let me show you a bit about how I look at charts. Okay. So over here, you can see the long-term trend of Alphabet. Now, again, when you look at a great company, the long-term trend must always be up. I repeat, the long-term trend must always be up. Okay. And once again, does it go up in a straight line? No, it goes through wave patterns, right? Wave up, wave down, wave up, wave down, wave up, wave down. Again, when you want to buy a great business, when do we want to get in? After a wave down, let's call this A, or after a wave up to, let's say, B or C. A, right? That's right. We always want to buy after a wave down. Write this down. We always want to buy after a wave down here. Right? We want to get in before the wave up. Or if not, at least near the wave up. Now, some of you may say, Adam, how do I know it's the bottom of the wave? How do I know it's not going lower? Right? Here's the thing. We can't always predict the exact bottom. No one can predict the exact bottom. Sometimes you buy, it could still go lower. Definitely. Right? As long as you buy near the bottom, that's good enough. You don't have to buy at the bottom to make money. Near the bottom. So even if you bought here, right, and it still went a bit lower, who cares? You still make money later, right? Or whether you buy here, or you buy here, or you buy here, or you buy here, it doesn't matter. You still make money. As long as you don't buy near the top of the wave up. Now that's dumb, right? So how do I know when it is near the bottom? Well, I look at support levels. I look at historical support patterns using moving averages. So let me put in my favorite moving averages right now. There we go. So can you see these colorful lines? These are moving averages, and moving averages help us to determine the support levels. Now you can see that for any stock, it goes through shallow wave and deeper wave. All right, check this out. Shallow wave, shallow wave, shallow wave, deep wave, shallow wave, shallow wave, shallow wave, deep wave. Now, for Alphabet, let's look at the wave patterns, shall we? Wave up, wave down, 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 wave up, wave down. Now, these are shallow waves. Notice that for Alphabet, during a shallow wave, which level does it hit? Where's the support? Which line? Which color line? The red dotted line. That's the 20 EMA on monthly candles. So notice every time it hits the dotted red line, toing, 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 toing. Right? So that is a no-brainer. So that tells you that you can draw a support level or a buy level at this red dotted line. Ta-da! There we are. So in a shallow wave, you can buy, 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 buy. Now, during a bear market, in a crash, we have a big wave down, right? So during the big wave down here, bam! Where is the support? Where is the support? The support is at the blue line, the 50 moving average. So for Alphabet, every time it hits the blue line, that is the last level of support in a bear market. Okay? That's why last year, you can see after a big wave up, we had a big wave down and we hit the blue line. That was the ideal buy level. We bought a lot last year. My students and I, we bought a lot last year. And you can see now it's beginning to what? Wave up. So right now, where are we? We are not at the top of the wave yet. We are like 1/3 there. So it is still in a buy zone, in my opinion. Got it? Got it. Okay. Now, how about the other stocks? Which ones are worth looking at? Now, so like I said, one of the most important things is the moat of the company. The moat tells you, can it be easily disrupted by competition? Okay. So here's a free gift for you guys. I have put in the moats of the various businesses. All right. So again, I will invest in wide moat and narrow moat, but I avoid those with no moat. Okay. So what are wide moat companies? Meta, wide moat. Amazon, wide moat. Alphabet, wide moat. Baidu, wide moat. Tesla, narrow moat. Now, those of you who are Tesla fanboys, don't freak out. It's a narrow moat. Okay, like it or not, Tesla, there are a lot of competition, right? You've got BYD, you have got a lot of EVs and all that, right? So it's a narrow moat, right? Adobe, wide moat. Palantir is a narrow moat. Although it's a narrow moat, I'm still buying it. Or I still bought it, right? But when I buy narrow moat companies, I don't buy too much. I usually buy a smaller position because it is a bit less certain because it's a narrow moat. But I believe that Palantir eventually can become a wide moat. Okay. By the way, narrow moat can grow wide. Wide moat can become narrow. And narrow can become no moat, right? Like if you ask me historically, Nokia was a wide moat. And then the wide moat became narrow and then no more moat. Okay. Sony was a wide moat. Wide moat now become narrow. Right. So the moat can change over time, but it doesn't change overnight. It takes years and years for the moat to grow or deteriorate. Okay. C3.ai, no moat. No moat. Okay. UiPath, SenseTime, no moat. Dynatrace, Datadog, narrow moat. ASML, confirm wide moat because ASML is a monopoly. is the only ASML. What do? They make photolithography machines that is necessary to make the semiconductor chips. And they are the only company in the world that can make the ultra UV photolithography machines. They're the only company in the world. No one else can do it. That's why it's a white mode. They've got no competition, right? Applied Materials white mode as well. AMD narrow mode, NVIDIA white mode, Intel used to be wide, now become narrow, Samsung narrow, TSMC white mode, SMIC narrow, Texas Instruments wide, Qualcomm narrow, Global Foundries no mode. These ones are already replicated here, so I won't mention it again. Oracle is a narrow mode. Snowflake, actually, there's no mode for Snowflake, right? It can easily be disrupted. Okay. Microsoft is a white mode. Definitely is confirmed as a white mode. It's a super duper white mode, right? Microsoft. Okay. So let's look at a few more. Some of you would say, how about C38I? That's been getting a lot of hype recently, especially the ticker symbol is called AI. Okay, so, is it worth investing in? Well, first, there's no mode. Okay, and if you look at the fundamentals, let's look at the fundamentals of C38I. So again, it's still a fraud. It's still a fraud. It's not making money, right? So revenue is growing, and then, but it's still losing money, right? And the free cash flow, the free cash flow is still negative. So as an investor, would I dare to buy this? No. Does it mean it won't go up? I'm not saying that. Of course, it could go up. It could go up based on hype. So I can tell you that there are many stocks that I don't buy that still go up. And that's fine, right? And there are many stocks that I don't buy that will go down, right? So it doesn't matter to me whether it goes up or goes down. Like some people say, oh, Adam, you didn't buy Tesla, it went up. That's fine. I'm not saying it can't go up. It can go up. It's just that I'm not comfortable buying it. I'd rather buy something else that to me, I can sleep better at night, So remember, rule number one is not about making the most money. Rule number one is never lose money. And rule number two is then getting the best returns on the safest companies. It's the same thing with cryptocurrency, a Bitcoin. Yeah? I'm not saying it can't go up. Sure, because of the hype, could Bitcoin go to $1 million? Possible. I'm not saying it can't. It could, but could it go to zero? Also can, right? And if my number one rule was to make the highest returns, would I buy Bitcoin? Yes, I would. Would I buy C38I? Yeah, because I want to get the best returns, right? But like I said, my number one rule is not getting the highest returns. My number one rule is to never lose money. That's why I'm a very conservative person. I only buy stuff which I know 100% I'm sure to make money, and that is what makes me sleep soundly at night. And again, do all my students follow me exactly? No, some of my students, after they learn from me, they are a bit more aggressive, and that's fine. That's why I've got students today, in fact, many students who make a lot more money than me, who get higher returns than me, many of them. And I'm very happy for them. I'm not like sad, I'm happy because they are willing to take that extra risk. Maybe they are younger or they are more gung-ho. It's fine, so you got to invest based on what you're comfortable with. Understand? Make sense, everyone? Yeah. So C3I know. How about Snowflake? Would I invest in Snowflake? Again, Snowflake has no mode. It can easily be disrupted by other players. So that concerns me, right? And again, you can see, revenue growing, but still losing money. Although free cash flow is now positive, but it doesn't have a strong mode. So I'm a bit concerned. Now, PayPal is very cheap right now. But PayPal, I don't know how strong their mode is. I think they can be very easily disrupted, and that's why I never went into PayPal. Same thing with Zoom. Zoom was a very hyped up stock. Anyone bought Zoom last time? And I used to say that, no, I dare not buy Zoom because I think Zoom can easily be disrupted by Microsoft Teams or by other players. You know, it doesn't have a very strong moat. So it's all about moat, you know. United Health, moat, Charles is asking, is a wide moat, Charles. United Health is definitely, sorry, it's a narrow moat, not wide moat, it's a narrow moat. Yeah, United Health is a narrow moat, yeah. Okay, so let's move on to the third key. Now, again, what was the first key? First key is know what to buy, right? The top 1% of the best companies in the world. Okay, so again, in the value momentum investing course that you can enroll for later on, we'll go into detail. The 7 steps. How do you find the best companies in the US, the best companies in India, the best companies in Europe, the best companies in China? There are a lot of great companies in Europe as well. There are a lot of great companies in India, in China, and it's the exact same criteria, no different. Okay. Number 2 is to know when to buy. All right. So when you buy, when it's undervalued. So again, in the course, you're going to learn how to calculate intrinsic value. You're going to learn how to read the chart patterns, how to use the right moving averages. Okay. Now, the third key is to know how many shares to buy. Like I said earlier on, don't put all your eggs in one basket. Never put all your money in one stock. Always diversify into minimum at least 8 great companies. Now, some of you may say, but Adam, I've only got $500 to invest. Do I still buy 8? Yes. Yes. Adam, I've only got 1,000. Yes. I don't care whether you got 500 or you got 1,000 or you got 10 million. You got to buy at least 8. Now, you don't have to buy at once, of course. You only buy when they are at the right price. But eventually, you want to have at least 8. Okay? The great thing is that with certain stockbrokers, like Interactive Brokers, you can buy fractional shares. That means you can buy less than 1 share. You can buy 0.1 share or 0.01 share. So that allows you to diversify better. Okay? Let me use an analogy. Imagine you're on a plane that has got 1 engine only. But it's a great engine. It's a Rolls-Royce engine. Would you feel safe? You tell me, guys. Would you feel safe on a plane with 1 engine, even though it's a Rolls-Royce? No, right? Because what if it gets hit by a bird strike, or some malfunction? You're dead, right? Now, what if I now told you that the plane has 8 Rolls-Royce engines? What is the chance of all 8 malfunctioning? What's the chance of all 8 getting hit by birds? It's almost impossible, right? So at the very most, 8 engines, at the most 2 fail. Hey, you got 6. Your plane can still fly. You get the point, everyone? Okay? And that's why, many years ago, Warren Buffett said this. That stuck into my mind. He said that if you buy a group of companies that are all great businesses, you buy a group of them and you buy them when they are selling undervalued, collectively, it is impossible to lose money. It is impossible to lose money. So when people say, Adam, is investing risky? Is investing risky? Everything in life is risky if you don't know what you're doing. If you do it the wrong way, including getting married. Getting married is the riskiest thing you can do in your life if you marry the wrong person. Same thing, is swimming risky? Yes, swimming is risky if you don't take swimming lessons, if you don't know how to swim. Driving is risky if you don't know how to drive. The trouble is many people, they invest without learning how to invest, without following all those rules. And of course it's risky. Of course you can lose a lot of money, right? But if you know how to invest and you follow these rules I'm teaching you, it is impossible to lose money. I repeat, it is impossible to lose money. And these are not my words. These are the words from the great Warren Buffett. You buy great companies, you buy a portfolio, you buy undervalued. It's impossible to lose money. So is there actually a holy grail? Is there actually a zero risk way? Yes, this is it. All right. Now, of course, I'm not saying you only buy 8. I'm saying minimum 8, right? A lot of my students, they might buy 15 or 20 or 25. So that's even safer, right? Okay. Now, the other thing you're going to learn about portfolio allocation in the course is that when you buy 8 or 10 or 20, don't buy the same type of company. Don't buy all technology stocks. You have to diversify into several sectors. So for example, if you look at my portfolio, I've got healthcare companies. I've got financial companies in finance, right? Like health insurance, like ratings agencies, right? I've got consumer discretionary retail stocks, consumer staple stocks. I've got communications companies. And then, of course, I got, finally, technology companies. So you are diversified across different sectors so that your portfolio will do well in any economic condition, recession or no recession, high interest rate or low interest rate, high inflation or low inflation. Your portfolio will do well because it's a bulletproof, resilient portfolio. And also in the course, I'm going to show you that certain stocks, you buy them to get high growth. We call them the growth companies, right? Then some companies I buy may not grow very much, but they are very defensive. They're very predictable. In a recession, bear market, they don't go down. They will protect the rest of your portfolio. Like, again, United Health, for example, Johnson & Johnson, Pepsi, Procter & Gamble. These are the defensive names, right? And then I also buy high dividend companies. For my Singapore dividend portfolio, I own a lot of REITs in Singapore, which I've got a REIT course that you can learn as well, where I teach you how I select REITs for high dividend. And certain turnaround companies that we buy the companies because they are turning around into profitability, right? So you need to diversify. Okay. Now, next question is when to sell. Okay. When do you sell a stock? Now, again, for me, I sell for two reasons. Number one, if the business fundamentals permanently change, that means they lose their competitive advantage over time. Like I mentioned, PayPal, General Electric, Intel, Nokia. These are companies that lost their competitive advantage, or IBM. Now, I never owned these companies, by the way, right? But if I owned them at that time, I would sell them. And I'm going to teach you in the course, how do you sell before everyone else? How do you look at the leading indicators that tell you that the company is losing its competitive advantage, even before it shows in the financial statements, right? Once you have that, you got to get out, okay? Second, I also sell if it's way overvalued, right? So for example, if a stock is worth $100 intrinsic value, once it starts to sell at 200, double the valuation, I sell a bit. And as it goes up, I will sell a bit more. I will exit in stages. And sure, it could still go up a bit more, but eventually it will always collapse back to the true value. That's where I reaccumulate. That's why for me, NVIDIA, I already sold half. And yes, after I sold, it kept going up. It's still going up now, all right? But eventually it will come down. When, I don't know, I can't predict. But eventually it will come down a lot. And that's when I will rebuy my second half, all right? So these are the reasons to sell. You should never sell because of news, right? You should never sell because of news, right? Because there's always bad news in the world. There's always something to worry about. And never sell because of some opinion or some prediction by some prophet of doom. You know, all these people, ignore all these people. They are full of crap, okay? You know, this guy called Peter Lynch, he said, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed, right? If you read all these news, US government shut down, right? S&P downgraded US debt, Chrysler, GM filed for bankruptcy, US government shut down, trade war, yield curve invert. If you read all this crap in the media, you will not have gotten close to 500% returns during this period, during the fifth wave. Okay? How many of you used to listen to all this rubbish? How many of you used to get influenced by all these prophets of doom, or I call them the doomsday porn star? They like to come out and tell you that the world is ending tomorrow. Every year they tell you the world is ending. But behind the scenes, those bastards are secretly buying, right? So like I said, when you take the course, whatever you learned today, has it been useful so far? Has it changed your mindset about investing? Great, you know. And what you learned today so far, use it. It's very, very powerful, but it's only the tip of the iceberg. It's only scratching the surface. Today, what I'm sharing with you in less than 3 hours, I'm doing my best to teach you as much as I can. But in 3 hours, I can only teach at the most less than 3% of what you need to learn. That's why you have to take the course, take the value momentum investing course. That's where we cover everything. That's where you learn everything. Every intricacy, every tip, every nuance about businesses, about the market structure, about market waves, right? And once you learn everything, you have the confidence to manage your money. You have the confidence that your money will grow consistently, even with bad news, even with bear market, even with volatility. You no longer worry. You no longer have stress because you know that it's going to keep growing. You know you're going to hit that multi-million-dollar nest egg. You're going to be financially secure over time. Okay? Remember that financial success does not happen by chance. It does not happen by accident. It doesn't happen by luck. It happens because you have a plan. Do you have a plan? All right. And number two, you have got the skills to execute the plan. The last 4 years were not easy. Usually a bear market happens every 6 years. But last 4 years, we had 2 bear markets because of COVID. No one can predict COVID, right? No one can predict the banking crisis, the high inflation, all came from COVID. But despite that, I managed to, like I said, just now, 128% return in my portfolio. I beat the S&P 500 over the 4-year period. You know? 2019, I was up 47%. 2020, during the COVID crash, I was up 44% here, 41% here. I was up 791,000 US dollars. I'm not showing this to impress you or to show off to you, but to tell you that I've got skin in the game, right? When my students, they join my community, my subscription, you know, there are a lot of people out there who sell newsletter, who give you all these buy and sell alerts, right? But they themselves don't buy. They're just analysts. They just recommend shit, right? They don't actually buy themselves. For me, I tell my students, when you subscribe to my UIP, I don't recommend stocks to you. I do not recommend stocks to you. That's not what I do. I do not advise you or recommend stocks to you. I show you what I'm buying every day. I show you what I'm selling, and I show you the research. I show you all my research. You read all my research so that you learn to think like me. You learn my process. So eventually you don't need me anymore. Eventually, when I get hit by a truck and I die, you can keep doing it yourself because you have learned the skills. I'm not giving you a fish. I'm teaching you how to fish. All right. In 2021, right, I got 23% return on this portfolio, 10% on this one. This was quite a bad return that year. You know why? Because this portfolio, I had a lot of China stocks. I had Alibaba, I got Tencent, I got, what's the other one? Ping An Insurance. They're all still great companies. It's just they got hit in the short term because of regulation. My China stocks dropped 50, 60%, but I still went up 10%. It's all about diversification. And I also trade options to generate extra income. So I will be having a session where I show you my options trading techniques and track record. This will happen on Monday, Singapore time. All right. So do join my options webinar and my stock trading webinar as well. Yeah. And I still managed to walk away 400 grand that year, which is not too bad, right? And again, 2022 was a down year, right? We all went down. I went down as well. As you guys know, I shared on my YouTube video. I had a drawdown as well, but now made everything and higher, right? So all-time highs since then. No, not all-time high yet. Or not all-time highs yet, sorry, but made back the drawdown, all right? Okay, so we're coming to the end of this webinar, but a lot more to share. Are you guys still there with me? Cool. So remember that coming up, I'll be doing a Q&A session. And when you stay to the end, you'll be getting my latest monthly newsletter. You'll be getting the latest newsletter. And we will open up 60% discount off the courses, of my investing courses, of the trading courses, and of the UIP, the Ultimate Investors Playbook subscription, where you can mirror how I invest and trade every day. So now thousands of students are learning to invest with me side by side. Okay. So what do you think, guys? Is it a good time to invest? Markets up in a bull run in the 9th month. It's gone up a lot in the last 9 months. Is it still a good time to invest? Okay. So like I told you just now, every year, there are always great companies that are still at a discount. You just have to find them, right? And that's why in the course, I'll also teach you how to use screeners, how to screen to find these great companies that are cheap, even on very bullish years, right? But remember this. Remember I showed you this chart again? We are now in a secular bull market. And you can see the secular bull market lasts 16 years here, 20 years here, and I believe it's going to last at least 20 to 25 years this time. Okay. And we are right now, sorry, not 9. We are right now in the 10th year of the secular bull market. We're only halfway. We've got at least another 10 more years to go. So it's not too late, right? But again, remember, it's not going to go up in a straight line. There will be still ups and downs. But we've already had 2 bear markets recently. We have already finished our quota for bear markets. Again, that's my guess. I could be wrong, but that's my opinion. Now, those of you who have been following me, you know that we just are in the early stage of a bull market, right? And let me just show you this technique again in case you guys missed my technique. This technique is called the 50-150 moving average crossover technique. And you can go and test it out yourself. And this is taught in detail, by the way, in the investing course. Yeah. I teach all these techniques in the investing course. In fact, there are a lot more techniques in the investing course that I teach. This is just one of them. So let me show you this technique very briefly, right? Okay. So this technique is a useful technique to identify new uptrends and to identify downtrends in the market. Yeah. So you see 2 lines here, the blue line and the green line. Okay. Now, the blue line is the 50 moving average, the 50 simple moving average. That's the blue line. And the green line is the 150 simple moving average. So how does it work? Very simple. Whenever the 50 blue line cross above the 150 green line and they both slope up, that's a uptrend confirmation. Okay, and that precedes bull markets. So did we have the signal in January? Yes or no? Yes. That's why I called the bull market. It was not just a blind guess. It's looking at technical signals. So you can see 50 cross 150, sloping up. That triggered the bull market. So we just started here. We are just in the early stage of the bull market. Again, you can back test this technique. Go back in history and see. Over here, 50 cross 150, sloping up. Sloping up, that is a signal of a new uptrend, right? Again, going back. Same thing here. 50, cross 150. Sloping up, triggered the new uptrend, right? By the way, if you look at this one over here, is this an uptrend signal? This one, the blue cross above the green. Is this an uptrend signal? Yes or no? Was this an uptrend signal? Yes or no? No. Why? Because the green did not slope up. The green is sloping down. Can you see that? Can you see it sloping down? So like I told you, they must both slope upwards with the 50 crossing. That signals the uptrend. So this is a very powerful signal. Now, does it predict bull market 100%? No. There's no 100% tool that can predict the stock market. But if you backtest this for the last 10, 20, 30 years, the accuracy is 90%. It's got a 90% accuracy of forecasting the next bull market. And we got the signal in 15 January. All right. So again, this is one of the many techniques that you will learn, right, in the investing course. Now, some people would ask are we in a bubble already? No, we are nowhere near a bubble. Okay, why? If you look at all the previous bubbles, this was the gold bubble in the 70s. Can you see the gold bubble? This was the internet bubble in the 2000. That was the China bubble. That was the biotech bubble. That was the Bitcoin bubble, right? This is the ARK bubble. So right now, if you look at AI, right now, is it anywhere near any of these bubbles? If you compare AI now to the .com, it is not even halfway. So we have a long way to go. Okay, we have a long way to go. Now, remember that what happens in a bubble, it tends to be like that. This is the thing, right? There's always an innovation trigger, then it will go up, and then it will later collapse, and then it come back. And this is where 95% of companies will die. 95% of companies will die, then only 5% will survive and do well. So in terms of the AI revolution, if you ask me, we are somewhere here. We are somewhere here. So we have a lot more to go here. Okay, and this is when we have to start getting out. We have to start selling. How do you know? I'll teach you a lot of techniques in the course. How to measure when it's way overpriced. We look at technical signals, when to start scaling out. All right, don't be greedy and hold on to the end, right? And then after the burger collapse, it gets cheap again, then we accumulate, but we only buy the top 1%. Remember, we only buy the top 1%, and then we rebuild again. So if you look at the .com bubble, that was exactly what happened. This was the .com internet bubble, right? We had a 5-year run, 5-year run. Okay, right now we're only 9 months. We're only 9 months now. 9 months now, okay? 5-year run, collapse, and then the whole thing goes up. Okay, are you excited? So along this journey, along the journey, there are going to be a lot of ups and downs. It's not going to be a smooth ride. There's going to be a lot of ups and downs. That's why you need a very strong community. That's why once you join our courses, once you join our community, we talk in the community, we chat 7 days a week. Every day we're chatting. This morning, I woke up Saturday, I start to chat with my students. All right. 18 hours a day we are chatting, so that together as a community, we are able to help each other to spot the latest trends, to spot the danger signs, to spot the patterns. And that's how we succeed together. Because to invest alone is very difficult. Invest alone, you lose interest, you lose motivation, you get distracted, you get influenced by get-rich-quick methods, you sell at the wrong time, you buy at the wrong time. It's not worth it. But when you have a community behind you, together with you, not just me, all my trainers, all my students who have been, I've got students following me now for 18 years. When I first started teaching this class It was 2005, 18 years. They're still in my community with a lot of experience to share with the new students. No, the community is not on Facebook. It's on Discord, right? And the community that we have on Discord, okay, you can only get access when you enroll in the course, in the Value Momentum Investing course. You enroll in the course, you'll be in our community for a lifetime. It's a lifetime membership. Okay, it's a lifetime membership. So let me introduce you to the Value Momentum Investing course. This is our most popular course, and it's the first course I suggest that everyone learn, because it's the most important course where we cover everything about investing, okay? So they're altogether 12 lessons. And when people ask me, Adam, what kind of students attend your class? All kinds, okay? I would say roughly 1/3 of my students are newbies. They have never invested before in their life. They've never ever bought a stock before, and they come in completely new. So that's why in the course, we start from ground zero. You learn the ABCs of investing. What's a stock? What's a business? What is the stock market? What is a stock exchange? What is the stock index? What makes the price go up and down every day, right? All the basic stuff. Then another 1/3 of my students have invested before. Some of them have invested for 7, 20 years, but lost money. You know, I've got many students who tell me, Adam, I lost money for 7 years. I lost money for 20 years. And then they come to the class, they know why they lost money. And they start to apply what they learn. They get rid of the lousy stocks that they're holding, replace with great companies. And then they make back all their losses. And after that, they start to grow their account. And then another 1/3 of my students who come are already doing very well. They're already making a lot of money in the markets. In fact, I've got quite a number of fund managers attending my class in the last 18 years. I've got a lot of private bankers, a lot of analysts who attend my class. And some of them are very good investors, but they want to learn, you know, the new, more techniques on how to up their game. So whether you're a complete beginner, you know nothing, you know zero, or you're someone who's got a CFA, you're someone who's a fund manager, wherever you are, this course is going to bring you to the next level, all right? So for example, William, who attended the course a few years ago, he was a complete newbie. He knew nothing, zero, right? And he said, Adam, this is the second year after graduating from your course in June 2019. I took a snapshot report card. My account has tripled in 2 years, right? 106% first year, 198% the second year, right? That's William. This is Tony Bach. He said, I started last July, finished your course in November. This is from investments. Total realized gains, including last year, 120,000. Total gains for 8 months, 27%, right? Your courses are worth its weight in gold. I'm 38 and want to retire by 55. From your teachings and product you provide, I'm going to achieve this goal. This is Gina. Gina's from the US, right? 40% returns. 60% in her first year, 2020. 40% return in 2021. Okay. She said, I started buying stocks 20 years ago and I was hit or miss on profitability, right? And she said, I'm not sure exactly when I came across Adam on YouTube. It was towards the end of 2019. After a few months, I decided to take the Whale Investor course. Following that, I enrolled in the trading course and options course, right? She said, from this time last year, I'm up 60% return and year to date up 40% return. This is from my students just this year. In fact, last month, right? Foxy said, this is the best performance ever I did in my investment time, thanks to Adam. After doing the course, following the VMI rules, I'm up 40% this year. This is 2023. Lucas said, Adam, just want to say my portfolio is up 30% since last year following the VMI principles, way above the S&P 500. I'd like to thank you for that. Markets used to stress me out before the course. Okay, Jensen, since you're flexing, I'll flex mine as well. highest I've ever achieved in my 5 years of investing journey, right? He spent 3 years experimenting, doing it himself, and then 2 years following my strategy, Adam's investing strategy. Thank you, all right? Oscar from Sweden, he said, hello, Adam, buying this course was one of the best decisions I've made in my life. Last year, I didn't have a clue what I was doing in the stock market. I ended 2018 with my portfolio down 17%. Early January, I bought this course, and at the moment, I'm up 43%. Just want to give a big thanks to you for the value that you provide, right? And it goes on and on and on. And if you go to YouTube, under success stories, you can hear their live video sharing. And on Facebook, on Twitter, you can also see the regular postings of their results of all my students. Their track record is all there, you know, for the last 18 years. So some people ask me, Adam, how much do I need to get started investing? Do I need a lot of capital? No, that's the beauty of the stock market. You can start with as little as $100 or 500 or 1,000 or 10,000 or 100,000. It's up to you. You know, there's no minimum account to open with a broker nowadays. And I tell people that even if you have got a little bit to start investing, start. Because if you don't start investing with small money will never grow into big money. You got to start somewhere. I started myself with very little money. I started at 17 years old. I'm now 49. I've been in the markets now for over 30 years, right? And I can tell you that the earlier you start, the earlier you're going to reach your financial goals, the earlier you're going to reach that couple of $1 million of nest egg, the earlier you can be financially free from this rat race. And every day you delay, every month you delay, you're delaying your ability to compound your wealth. Why? Doesn't make sense, right? Start as early as you can, all right? This is Eric. Eric said, I started watching Adam about 3 years ago after losing 70K on Bitcoin. My net worth at that time was 750,000. I've spent about 3,000 on several courses with Adam. A year ago, my net worth peaked at 2.2 million. Now it's about 1.8 million because this was last year during the drawdown. It dropped to 1.8 million. But I made 2.5 times in 3 years. I don't really care that my net worth decreased in 2022. It was only a paper loss. I do care about the 150% gain with just my 3,000 investment. You know, that's why all my students say this. They say, Adam, investing in my education, in your classes was the best investment I made in my life. And people ask me, Adam, whatever I invest in your course, in your subscription, can I make the money back? It's not about making the money back. It's making back 10 times. It's making back 100-fold. Because once you learn these skills, no one can take it away from you. Once you learn these skills, it will help you to manage money, to invest intelligently for the rest of your life. And these are things you can teach your kids. So for Eric, imagine a 3,000 investment in his education first, grew his net worth by 2.5 times in 3 years during a bear market recession. Imagine during a strong bull market. Okay. This is Kedar, one of my first students from Nepal, and he got 80% return his first year after the course. And he said this, he wrote to me, he said, Adam, you know, I got 80% return, but from 2011 to 2018, I lost everything, 100%. I wish I had known you around that time. I lost 7 years of my life, or not his life. I lost 7 years of my savings, all right? And this guy, Luksak, I think he's from Thailand, right? He said, thank you so much. This is one of my accounts. Pretty much all my accounts are good like this. I've made back all my losses in the last 20 years. So let me ask you a question. How many of you have lost money before because of bad investment decisions? How many of you have lost money? Do share. Okay. And if you lost money before, I can tell you that you are not alone. Many people have lost money before. Me too, all right? I started investing at 17 years old, and no one supported me. Everyone said it was a bad idea. Only my mother was supporting me. In fact, my mother lent me her account to trade because I was too young to open my own account, right? I started at 17 years old. And let me tell you that for the first 8 years, I went in circles. I made all the stupid mistakes that people make. Whatever mistake you made, I bet you I made that mistake before in my first 8 years. And whatever money I made, it was luck. And it did not last, right? I make money, then I lost it. I make money, I lost it. And I went in circles for 8 years. But I didn't quit. I didn't give up. I said to myself, there must be a way to really make consistent profits. So I studied the markets. I studied businesses. And the last 20 years is where I built my fortune. So I'm here to tell you this. Doesn't matter how many mistakes you made in the past. Doesn't matter how much you lost in the past, because the past does not equal your future. Your future depends on what you do now. This moment right now is the new opportunity, especially now we entered the new innovation super cycle. It's there. It's the strategy you use today. It's the actions that you take today that's going to determine your destiny. Your financial destiny is not left to chance. It's in your hands. So grab it, learn it, do it. Okay? Some people ask me, Adam, must I take your course in order to learn all these skills? Can I learn it on my own? The answer is yes, you can learn it on your own through trial and error. But I can tell you that if you learn it on your own, it's going to take you at least 5 years of losing money, of wasting time, of going in circles. I know, because I took 8 years, right? So if you can take 5 years, you're better than me. So the reason people take this course, they join my communities, they say, Adam, I don't waste time anymore. I want to cut short my learning curve. What you learn in 8 years, Adam, I want to learn it in 4 days or in 3 days. So that the next 5 years, I'm not going in circles. I'm not wasting time. The next 5 years, my wealth is already compounding. So 5 years from now or 10 years, I'm financially free. I'm out of the rat race. And that's what my students achieve, right? So it's about cutting short your learning curve. So there are altogether 12 lessons in this course. By the way, this course is an on-demand course. That means it is all pre-recorded lessons. Everything you need to learn are there. And these lessons are updated regularly with new examples as the market change, right? So you can watch it anytime, anywhere, as many times as you need to, at your own pace. And pretty soon, we're going to roll out a new subscription payment system. That means to say, you have to pay a subscription every year to renew the course and to renew the community. It's like Netflix, you have to pay to renew, right? But for now, it is still a one-time payment for an unlimited lifetime subscription. It's going to be changing very soon. That's why I tell students, please enroll as soon as you can, because once we have the new system, you have to subscribe every year. No longer a lifetime, but for now, it's still a lifetime subscription, only for now, right? It's going to change really soon. So grab it while it's still a great deal, okay? So 12 lessons. Lesson 1, you learn all the basics of the stock market, which I mentioned. Lesson 2, you learn all about investing in ETFs. ETFs alone is a very, very comprehensive lesson. There are hundreds of ETFs. How do you choose the best ones? What's my selection criteria for ETFs? You want to invest in US ETFs, India ETFs, China ETFs, European ETFs, okay? And specific entry and exit rules for ETFs. How do you build an ETF portfolio? Okay. Lesson 3, the key steps to profitable investing. Lesson 4, fundamental analysis. This is where you learn how to read a business inside out to know, is it a great business or is it a lousy business? Are there red flags, danger signs to avoid? Okay, So you learn how to read financial statements, how to identify growth potential and danger signs, how to screen for the best stocks in the market. You know, many students, they say, Adam, they all say the same thing. I wish I took your class 10 years ago. I would never have bought HiFlux. I would never have bought Nobel Group. I would never have bought SPH. Why? Because once you learn this, never again would you buy a lousy business, because you know how to read the reports. Okay? And I'm also going to teach you how to identify when businesses are creatively manipulating their accounts. When on the surface it looks good, but it's creative manipulation. I'll teach you all these tricks, all these tips we have learned over the years, so you avoid these dangerous companies. Okay? Excuse me. Bit of a cold. Lesson 5, you will learn all about stock valuation. Again, all the different ways to value a stock. Different. The way you value a bank, the way you value a REIT, the way you value a unprofitable business for speculation, and the way you value profitable business is different, right? Then technical analysis, how to time your buy and sell entries using technical patterns, right? Where you learn about support and resistance levels, price action patterns, moving averages, wave patterns. We go into detail. Lesson 7, you will learn my proprietary 7-step formula, where we put everything into this 7-step checklist. So that, remember, before you buy a stock, it's got to pass the 7 steps. Okay? Lesson 8, how to build a winning portfolio. How to diversify your portfolio to have maximum return and minimum volatility. How to select defensive versus cyclical stocks. And the 7 stock categories: growth stocks, dividend stocks, cyclical stocks, defensive stocks, speculative stocks, deep value stocks, ETFs, right? How to construct a portfolio with all these different types of stocks. Lesson 9, how to find investment opportunities. So you may say, Adam, how do I find the best stocks? There are thousands in the US, in China, in India. We use software screeners. So you're going to learn how I use screeners to screen out these great companies. How to manage your portfolio like a professional and exit. When do you start selling stocks, right? All the exit rules. Then a big part about investment success is psychology. In this course, I spend a lot of time on psychology, teaching you how to rewire your mind to think like a successful investor. So from now on, you don't invest based on emotions. Zero emotions. You don't invest based on reading the stupid news or the stupid opinions of prophets of dooms. You invest based on facts, on numbers, on technical patterns. That gives you consistent results. Lesson 11, how to choose the right stockbroker. There are many stockbrokers. How do you find the most reputable ones, the most established ones, the lowest commissions? In fact, most US brokers now have 0 commissions. But how do you choose the best ones, the best tools? You know, how to place orders, how to click buy, how to click sell, right? All the nitty-gritty stuff. Lesson 12, how do you turbocharge your portfolio using options? So I'll also teach you the basics, how to use options to sell covered calls, right? How to protect your portfolio during drawdowns, as well as how to use leverage responsibly. If you do want to use leverage, you have to use it responsibly to magnify your returns. Okay, so again, 12 lessons and hours of training. And again, it's a lifetime access. Once you enroll today, no more hidden charges, no more hidden fees, lifetime access. And it's not going to last long, okay? So we've got a 6-wave limited webinar bonus right now. So if you're listening to me, great, because you're getting this bonus. Those who left early, I'm sorry they don't get this bonus, right? Okay. So bonus 1, you'll be getting all my trademark investing tools that include the intrinsic value calculator, a portfolio manager, and portfolio dashboard. These are all the Excel files to track your investments. This is worth $300. Bonus 1. Bonus 2, you'll be getting a free lifetime access to my investors community. Again, 7 days a week, 18 hours a day, we are sharing ideas all the time. We are chatting. If you've got an idea for a stock, share the idea. We give you feedback. Other members also share ideas. You can also get their ideas. Again, in the near future, we'll be charging an annual subscription to be in the community. You have to pay every year to be in. But for now, no. For now, it's going to be a lifetime subscription, right? So it's a support system that has helped my students. This is Ronnie. He said, had I not belonged to this group, I could have been screwed big time. I just wish I had enrolled in the course earlier. This is John Twomley. Adam, I want to personally say thank you. I'm very new to investing and the stock markets. And at first, I tried to learn on my own. I lost a bit of money. And the best decision I made was to sign up for your Value Momentum Investor course. In 3 months, I tripled my course fee in the markets, right? This is Sunny from the US. Adam, I can't say enough. You're the best teacher in the world. I've been to many paid courses, but no one out there would take the time after hours, whether it's on a weekend or weekday, to answer questions and steer students in the right directions as you do. Every dollar spent on your course is worth millions. All right, this VJ. Seriously, I didn't expect the kind of support from Adam. He answers everyone and it's a great online course, but the support we get in this community is matchless. I keep asking my friends to join the course, right? So it's a very supportive community that we built. Okay. So this is what you're going to get for the VMI course. 12 lessons over 26 hours of training, right? Usual price, $1,899. You get the 2 bonuses. So the total value is $3,399. This is in US dollars. Okay. Now, the course fee, the package price for the course fee is $1,899. But hold on, later, there'll be a big discount bonus that you can grab, right? But for the course itself, it's $1,899. Now, besides the course, I'm also going to throw in the UIP. The UIP is the Ultimate Investors Playbook. Now, the UIP is not a course. This is not a course. This is an annual subscription where you get to mirror my investing and trading every day. Where what happens every month is I will do a deep dive analysis into the markets exclusively for my UIP subscribers. You get, right, this is the monthly deep dive analysis into the markets where I show you what are the best opportunities in the markets and what's happening in the markets. And then I will do a monthly portfolio review where every month you get to see every single stock in my portfolio and my portfolio allocation, and you know exactly how I allocate my portfolio. So this is a monthly review. So you can see how I manage my portfolio to help you manage your own portfolio, right? And every month, we also do 2 deep dive research where we do a 7-step analysis on the best companies in the world, where I will find a great business every month to present. And then students will also share what they want me to present. And I'll also present the stocks that they're looking at. Okay. And then you get daily alerts. So whenever I buy a stock, I sell a stock, I trade options, you get an immediate alert, why I bought it, why I sold it. Okay. So example, during the last 2020 crash, the bottom was here, right? 2 days after the bottom, you can see I started to buy. These were the alerts sent to my community, right? 25th of March, the day after the market bottom in 2020, added MasterCard at 236, added Estee Lauder at 158. March 30th, added at the time called Facebook at 159. Added Bank of America at $22 on the 30th of March. So you get in, you see how I get in before everyone else. You get all these live alerts. Okay. And then every time I enter a stock, I will explain why I'm entering it. You see the chart patterns, you see the intrinsic value. You don't have to calculate your own intrinsic value. In this subscription, I will calculate all the intrinsic values of every stock. That's great, plus monthly updated values, monthly updated buy levels, right? So I bought Estée Lauder at 196. I sold it at 259, right? And yeah, took profit 32% return, right? So all these are all in the sharing, okay? And these are my students in the UIP community, right? Sharing their track record as well. All right, I'm just going to skip all this, right? Thanks to Adam, my UIP stock portfolio is up 85% this year. This is just in 2023. Up 88%, you know. Okay, so for the UIP subscription, the usual, well, rather the total value you're getting is 6,007. That's the total value of what you're getting with all these things, right? Now, the yearly subscription fee is 1,900 US. The annual subscription fee is 1,900 US. Now, in this webinar special, we'll be giving you both the course and the UIP subscription. Both the course and the UIP subscription, if you add it together, it's 3,799. If you enroll now for the course, it's only 1,519. It's an absolute steal. Okay? That's 60% off the already discounted price. So to take advantage of this, you can scan this QR code over here, or you can click on this link that I believe that will be shared on the Zoom chat group, and you can grab this bundle, right? This is called the Stock Investor Bundle. That includes the Whale Investor course, 12 lessons, plus the UIP annual subscription, all for just 1,519.60 US dollars. Now, for those of you who just won the investing course itself, do let my team know. They will also have a special price for you if you just won that as well, right? Now, in addition, you'll be getting the latest, sorry, not the latest, I'm sorry. This is for those of you who enroll, you'll be getting a lifetime subscription to my investment newsletter as well. So this is a special 6-wave enrollment bonus, okay? And an additional free 2-month subscription to the UIP. So that's total of 14 months subscription of following me every day, 14 months, okay? By then, you should be an expert at watching how I invest and trade every day. So again, this is a fast action bonus, okay? Sign up for the Stock Investor Bundle in the next 15 minutes. And in addition, you will get a live stock investing jumpstart workshop worth $300 conducted by our resident trading coach for 3-hour session. Okay, so this is a special bonus for the first students who enroll in 15 minutes. Okay, so once again, here's all the things we're getting. You'll be getting the investing course, the UIP, the enrollment bonuses, the fast action bonus, all for just 1,519, right? Again, limited offer. Screen the QR code over here and click on the link below. All right. So I'm going to give you guys a couple of minutes to enroll. If you have any questions on how to enroll, on the payment, my team will be behind to help you guys out. Yeah. So in the meantime, go for it. Take massive action. Like I said, I can't force you to learn this. I wish I could. I can't. I can force my kids, which I did, right? My kids attended my investing course. They both started investing already. all I can do is I can encourage you, I can enlighten you, all right? But only you can give yourself this chance. So go for it. Give yourself this opportunity to learn this because it is life-changing. It has changed many people's lives in 18 years. It will change your life, but you got to learn it. You got to take massive action, all right? So go for it. And I'll see you guys in a few minutes where I'll do a quick Q&A session. Yeah, so take action. Okay, so as you guys are enrolling, let me just answer a few questions. Can I get the music down, please? All right, so yeah, like I said, as you guys are enrolling, let me just answer a few questions. And my team will be behind the scenes helping you. And let me just share the QR code. There we are. That's a QR code that you can use your camera, right? Or the link below over here. Yeah. Okay. So I know there are a lot of questions coming in. I'll do my best to answer those which I think are the most relevant. Yeah. And again, bear in mind that, I can't give you like stock tips or what, because it's not just about what to buy. It's when to buy. You must know when to buy and when to sell and how to manage the portfolio, right? That's why you need to learn all these things, yeah? Okay, can you give your market expectations over the next 6 months? Okay, so again, remember, no one can predict the short-term stock market exactly. We can only guess, right? We can only guess. But what you're going to learn in the course, it doesn't matter where the market goes in the short term, you will still do very well. But my best guess would be we'll probably have a correction in the next few months. Probably in August, September, October, we should have a bit of a pullback or correction, right? And then the last 2 months, we have a strong finish. And my guess is we should finish up 20% for the year, Again, that's my guess. How much capital do I need to trade full-time? Stacy's asking. Well, there's no minimum amount, like I said, right? You can start with, $1,000, $3,000, $5,000, $10,000. It's up to you, and nothing wrong with starting small. I started very small as well, and no matter how small, the important thing is to start. Because if you don't start, the small money will never grow into big money. You got to start somewhere. Okay. Simon is asking, what's the outlook for Hong Kong market in 2023? Again, impossible to predict for sure, but I am getting more optimistic that we should start to see a rebound for the Hong Kong market, right? Recently, the Chinese government is doing everything they can to get back investor confidence. They're inviting all the top CEOs, the top politicians to China. The Chinese government is doing whatever they can to stimulate the economy, to help the private enterprises. They're making friends with Jack Ma again. So they're doing whatever they can. So it's a matter of time that it should rebound. And I think that it should rebound by the end of this year, okay? What are the AI stocks that will disrupt the world? Well, everything I showed just now, right? I showed you the enablers, the enhancers, and the engagers, right? All those stocks, right? Okay, so let me see what other questions are there. Aaron is asking, if something happens to me, is there a structure in place to continue hosting your lifetime courses? Yes, of course, don't worry. I'm not the only guy. I've got a lot of great investors and great mentors in my company. Do I see market correction around October? Yeah, I just mentioned that. Yes. Sebastian is asking, what are some good Singapore REITs to invest in for Singapore? Well, there are quite a number of them, but look at the Maple Tree ones. They are pretty good. Ascendus is pretty strong. Frasers is pretty good. These are the stronger names. Jay is asking, would I go into Triple Q or S&P right now? They are both okay, right? So whether you buy S&P ETF, Dow ETF, or Triple Q, they will all go up. It's just that triple Q will go up more. Triple Q will definitely go up more, but triple Q is more volatile. Okay. Do you think there's any impact to NASDAQ after index rebalancing on the 24th of July? Let's put it this way. Remember that the stock market always prices in known information. So everyone knows that the NASDAQ is going to rebalance on 24th of July. So people are already buying and selling based on that expectation. So you cannot wait for that day to see what happens, because it's really happening right now. That's why the moment it was announced, you could see that the Magnificent Seven stocks already went down because people already sold them and rebalanced even before the rebalancing starts. Okay, so CS Ng is asking, are these stocks worth investing in? Market Access, so that's a great company. Estee Lauder, great company. Disney is going through a bit of problems right now. So Disney is a bit of an unknown, a bit of a turnaround situation. So if you invest in Disney, I would say not too much, just a bit. Expedia, no, I don't think Expedia has got a very strong mode. I think Booking.com has got a stronger mode. Okay. I wouldn't touch real estate developers like Country Garden, and I wouldn't touch real estate developers. It's too cyclical, too much debt. Chinese tech, they are very undervalued. I think they can easily double because they are very cheap. But in the long run, I'm still more bullish on the US than in China in the long run. All right. In the long run, I would still put 95% of my money in the US. Okay. Why Palantir is a narrow mode instead of a wide mode? Because Palantir is still a relatively new company that is not as dominant as Microsoft, for example. Would I buy Nike now? I wouldn't buy. I wouldn't mind buying Nike now. In fact, I already have some Nike in my portfolio. I already have some Nike. So Nike is a great business, and Nike is slightly undervalued. So it's not a bad buy. But bear in mind, Nike doesn't have a very high growth. It's just, very mid-sized growth. Okay. Let me just take a few more questions. Some of you asking me what will happen to the world when AI takes over. I don't know. Okay, I can't predict that, right? But all I can say is we have to learn how to leverage on AI tools to be relevant and not be replaced by AI. So we have a choice. Either we get replaced by AI or we leverage on AI to be more effective and we invest in AI so it helps us to become wealthy, right? What are the sectors to focus on right now? To me, one of my favorite sectors right now is healthcare, because healthcare is cheap right now. And of course, technology. But again, you have to look at individual companies that are still undervalued, right? A Japan stock market bull run. Any opinion about investing in Japanese stock market? Okay, to be fair, I don't know enough about Japan, right? It's not my expertise. So I tend to only focus on markets that I am very confident in, which is the US, right? Japan, I'm not very familiar, but I know Japan, in the long run, it's got a demographic issue. It's got a declining population. It's got a declining demographics, aging population. So I'm not too sure about the long run, right? Okay. All right, guys. So I apologize if I can't answer all the questions. I know there are a lot coming in, but we'll get back, all right, to you guys. We'll send you a reply, to help you answer as many as we can. So in the meantime, all right, enroll in the course, and I look forward to seeing you guys in the community really, really soon. Now, coming up next, don't go away, because coming up next, we have got Elson Chu. Elson Chu is an award-winning proprietary trader. Now, Elson is one of the best traders that I know personally. He has made millions in the markets, both the crypto markets and the stock markets. And Elson is an expert in stock market manipulation. In fact, he created a very powerful technique that I have learned myself from him on how to identify price action manipulations. You guys know in the short term, the market is all manipulated, right? Many times the market will come down, hit your stop loss and go up. It is all manipulated. So Elson uses the manipulation to his advantage. And using these techniques, he, for example, made 150,000 US recently on Palantir, all right? So if Elson's price action manipulation strategy, you can trade any kind of stock by learning how they manipulate it and how you take advantage of this price manipulation. So he's coming up really soon. Be sure to watch it. I'll be watching it myself because there's always something new I learned from him. All right. So that's coming up really soon, and enjoy Elson's session as well. And I'll see you guys tomorrow for my stock trading session.